record. If you are given the white paper, which is like maybe 5 pages or 6 pages or I don't know, okay, and they will tell you that do not turn the paper until you are told to do so or something like that, okay. The time that they are going to tell you that you should open the paper now or you have the 15 minutes to read. You see, the first question that you are going to see, we are going to talk about that first question today. And if you continue reading, and if you continue reading the paper, you are going to see question 4. So you are going to see question 4, which will also be for 20 marks. So we are going to talk about the question 1 and the question 4. This evening, we are going to talk about the question 1 and the question 4. The question 1 is always about group accounts. Question 1 is group accounts. Group accounts. So the question 1 is the group accounts or the consolidated financial statements. Under this one, they can give you either profit or loss. They can give you either profit or loss, or they can give you statement of financial position. So they can either give you statement of profit or loss, or they can give you statement of financial position. So it can be statement of profit or loss or statement of it can either be statement of profit or loss or statement of financial position. So statement of financial position. Or they can give you both, which it is not likely that they will give you both because of the time. So it's not likely that they will give you both because of the time. So they can give you a question that will ask you to prepare both the profit or loss and statement of financial position. But because of the time, it is not likely that they will give you both. But that doesn't mean that they can't give it to you. They can give you both, but because of the time, they might decide not to give you the 2 statements or ask you to prepare the 2 statements. All right. If they ask you to prepare profit or loss, what do you have to do? The first thing is preparing consolidated financial statements. The assumption is that you are putting. So if they ask you to prepare a consolidated statement of financial position, the idea is that you are putting 2 entities together as if they are one single or they are a single entity. You are putting 2 or more entities together as if they are single entity. That is what we mean by consolidated financial statements. So they say you should prepare statement of profit or loss, which should be a consolidated one. The meaning is that put these 2 entities together as if they are a single entity. So the first thing is you have to do is that you have to identify who the parent is. So identify who the parent is. So if you identify who the parent is, so identify the parents. So if you identify the parent, then you can put your skeleton there. You see, you don't have to start tackling your footnotes. Some of the footnotes are not for the students. Some of the footnotes are for the examiner himself. So you cannot be able to adjust all the footnotes. You are there to write exam to pass. So what you have to do is that if you are asked to prepare statement of profit or loss, identify who the parent is. Prepare your skeleton. Idris, Idris, where are you? Which platform are you so that I can share the distance with you?
I'm on the all the platform, the IFRS and the special class. So actually, I'm now going to the house because it was raining very heavily.
So how come we don't have?
So please.
How come you don't have the document? Because I've shared all of them.
No, I have the document. I want to know which one we are using. If somebody can reshare it, then I will know.
We are using the one that we have, the group account.
With a group account.
Yes, please.
Okay.
All right. Thank you.
Thank you.
All right. So if you are asked to prepare statement of profit or loss, the first thing is identify who the parent is. So if you identify who the parent is, then you can now put your skeleton there. Statement of profit or loss, then you put revenue. Then the revenue, you open your bracket. Then you can put a parent figure here, say 500. You count to cost of sales. Then you can put a parent figure there because you are going to add the figures of the two entities. So you can open it. Okay, I hope you join with a link. You join with a link. So say hi. There is a number in the link. Send hi to that number. I will send a document to you, Sule Hassan. So send hi to the number over there. There's a number in the link, which is 008. Send hi to that number. I will send a document to you. Thank you. All right. So you are preparing consolidated statement of financial position or consolidated statement of profit or loss. You are going to put two entities together, the parent and then the subsidiary. We don't consolidate an associate. So associate is not part of the group. So just identify the parent and then the subsidiary. A subsidiary is an entity that the parent is having what control over. The parent is having more than maybe 50 or 70% shareholding in that particular company. So identify who the parent is, put the revenue of the parent there, put their cost of sales, put their administrative costs, put their distribution costs, put their finance costs, put their tax expense. Then you now go ahead to read who the subsidiary will be. If you have now identified the subsidiary, the next thing that you have to do is that when was control achieved, or when did the parents acquire the subsidiary? From the date that you are from the date of acquisition to the date of reporting, is it a full year? Has the parents or the time that the parents acquired the subsidiary, is it a full year acquisition or is a 6-month acquisition? So if the reporting period is January to December and the parents acquire the subsidiary somewhere July 1st, it means that from January to June, the parents has no control over the subsidiary. So the profit for January to June, the parent is not going to have a share of it. So you start consolidating from July to December. So what you do is that from July to December is how many months? 6 months. You try to find 6 months of the subsidiary figures and add it to the parent figure. So you have to, after determining the subsidiary, you have to know whether it is a full year control or it's a 6 month or it's a 3 months. The question will tell you that you should assume that all revenue and expenses accrue evenly throughout the year. Sometimes they will not say something like that. They can give you a pre-statement. They can give you a financial statement where the subsidiary is having a revenue of 200 cedis. Okay, this is the revenue for the year. And the parent acquired the subsidiary on August. So the financial year is January to December. So they acquired them on 1st August. It means that they are going to have only 5 months control over them. And the question can give you the revenue for the first 8 months or the first 7 months. They can give you that the revenue up to August is 150. Then they will now ask you that you should consolidate. So the parents acquired the subsidiary on 1st August. That is 7 months after the start of the year. So the question will give you the revenue for the pre-acquisition, which will be from January to August. They are giving you a revenue of what, 150, but the total revenue of the subsidiary is 200. It means that from 1st August to December, the revenue that was generated is 50, which is a post-acquisition revenue. So you have to pay attention to the items very well. The question, sometimes the question can be very tricky. You have to pay attention to that. And I can tell you that this city, it is likely that you are going to meet statement of profit or loss. It is likely that you are going to meet a statement of profit or loss. But don't worry, we pick a question and we look at how to go about that. If you are preparing statement of profit or loss, don't say that you like preparing net asset table. So whenever you see a question on consolidation, then you start preparing net asset table. No, you have to know when the net asset table is relevant. If you are preparing statement of profit or loss, it is not necessary for you to show or to do workings for the net assets, because the net asset that you are going to show at reporting, the reason is to get a post-acquisition profit. And the post-acquisition profit, automatically you are going to get it from the profit or loss. You are now preparing statement of profit or loss. It means that the post-acquisition profit will be determined from a statement of profit or loss. So why or what are you preparing the net asset and reporting for? No. So if you are doing statement of profit or loss, net asset is not necessary. Even the net asset at acquisition, we prepare it when we are calculating a goodwill. So if you are preparing statement of profit or loss, the only workings that you need for the net asset is the one at acquisition, because that is the one that you are going to use to calculate the goodwill. And we only do this when there is an impairment of a goodwill and we don't know the figure for the goodwill. So the question will say that the goodwill has impaired by 10%. But the question is, do you know the value of the goodwill? No. So you have to calculate the goodwill yourself. That is when we do the workings for the net asset at acquisition. Apart from that, if you should be giving the impairment of the goodwill figure, the net asset at acquisition and at reporting, they are not necessary because we are not going to use the goodwill for anything. So you have to be very careful. You are going to use time. Don't go there and say you like preparing net assets. So you are going to prepare net asset at acquisition, net asset at reporting. The acquisition might be relevant because if you are going to calculate a goodwill, the acquisition might be relevant. But the reporting will be irrelevant and you are going to waste time. If you are preparing statement of profit or loss, there is no workings for NCI. We don't do workings for NCI. Why are you taking the NCI to? They are asking you to prepare statement of profit or loss, and you are doing workings for NCI, non-controlling interest. Why are you going to send that figure to? If you are preparing statement of profit or loss, we don't do workings for group return earnings. Where are you taking the group return earnings to? No, we take those figures to what? Statement of financial position. So they are asking you statement of profit or loss. You are doing workings for NCI, and the question they ask you to do workings for NCI. They don't ask you to show the NCI. You are doing workings for NCI, workings for group return earnings, workings for other components of equity. No, my brother, you are wasting your time. So you have to be very mindful of these things. Don't say that this is what you know. So you have seen a question, then you start preparing what? No, my brother. So for the profit or loss, the important items are you do workings for goodwill, you show the group structure, which is very important. The group structure, you show the group structure, you do your workings for goodwill when there is an impairment of the goodwill. That's basically those are the basic two workings that you're going to do. But if you have issues with unrealized profits, then you do workings for them and any other workings that might be relevant. But apart from that one, we don't do workings for NCI. Group return is no, we don't do workings for them. If you are preparing statement of profit or loss. But if you are preparing statement of financial position, you have to know that if A is having 70% in B, you see that the other people will now be having 30%. And this is what we call the non-controlling interest. The non-controlling interest because A is controlling 70% of the ordinary shares. But what is the portion that they are not controlling? That is the 30%, which we call the non-controlling interest. So you have to know that any gain or any loss that A will be making will be shared among what? The B. A is the parent. Any gain or loss that B will be making will be shared among the A and other what? Shareholders. Other shareholders. So for statement of financial position, you have to know the profit that you'll be sharing. So it is very important that we do workings for the profit. We show how we can get a profit. So the net asset table will be relevant there. The NCI will be relevant because we want to know the portion that the value of what? The shares that we are not controlling. So the net assets, the non-controlling interest will be very important. Goodwill will be very important because we want to show the goodwill as an asset in the statement of financial position. Group return earnings will be important because we want to show the results of the parent. That will also be important. So if you're preparing statement of financial position, those things are important. But you have to be very mindful. The question sometimes will tell you that the parent, the investor who will eventually be a parent has acquired what? Preference shares of the subsidiary. Which type of the shares gives ownership? Which type of the shares give ownership? We have preference shares, ordinary shares. Which of them gives ownership?
Ordinary shares.
Ordinary shares.
Okay, so you have to be very important. You have to be very careful with this particular issue. If you are buying preference shares, it means that you will be seen as a creditor of that particular company. So the question will say that the parents, in addition to the acquisition of the 50% of the shares of this thing, they have also acquired or they have also invested in the loan notes or the preference shares of what? Of the subsidiary. After you have gained a control of 70%, after you have purchased 70% of the ordinary shares of B, what does it mean? It practically means that you are the owner of B, isn't it? The meaning is that you are the owner of B. Is that the case? If you purchase 70% of B, does it mean that you are the owner? Practically, you are the owner of B.
Yes, sir.
Okay. If you are the owner of B and B is having preference shares, and B is having preference shares of 100 million, and you purchase 20 million, are you going to be classifying this as an asset? Would the parent be classifying this as an asset? You are the owner of the company itself, which is B, and B is owing some people 100 million, and you have purchased what? 20 million out of that. Are you going to be classifying this as an asset, and the subsidiary will be classifying this as a liability? Is that how it's supposed to be done?
No, we are
No,
not
sir.
going to do it.
So how are we going to treat this particular transaction? If you are consolidating, how are you going to treat it?
Yeah, I think you add it to your liabilities.
Yeah, this is not a time to be thinking.
So you add it to your liabilities.
No, please. This is not a time to be thinking. This is a time to say, because you don't have much time. You have limited time to write the exam, so you don't have to be thinking by this time.
Because of the single entity concept, I think this transaction has to be transferred out of the books of both investor and subsidiary.
Hey, someone is talking. I can't hear the person now.
Yeah, the single entity concept of consolidation, because the parents own part of the subsidiary, would have to cancel out the transaction from both the books of the investor, which is the parent, and subsidiary.
Why are you canceling?
Because it's like you are telling yourself that you own your own self, which is not right. So we just cancel it out and cancel the portion that the parents have invested in subsidiary.
Okay, that is nice. That's nice. Thank you. That is nice. Okay. Okay. You are having 70% of the shareholdings of B, and B is owing what? The other people 100 million. Indirectly, you are the one owing those people the 100 million because you are the owner of the B now. So B is having a preference shares of 100 million. Indirectly, you, the parents, you are the one owing what? The preference shareholders 100 million because you are the owner of B. And you have decided to purchase what? 20 million out of that. The meaning is that you have paid what? 20 million out of the 100 million. You are paying part of the preference shares. You are not buying because you are the owner of what? The company. So you are the one owing the what? The preference shareholders. So if you decide to purchase 20 million out of it, it means that you are paying back part of your what? Your debts. So this will be classified as part payment of what? The preference shares, or buying back of the preference shares, not by in the separate financial statement of these two entities. The parent will be classifying this as an asset because they are buying. They will classify it as a financial asset. And the subsidiary might classify it as a liability or a financial liability. Upon consolidation, you have to cancel it. The parents cannot be having investment in itself. So it will be treated as what? Part payment of the preference shares. The same thing applies to loan notes. The same thing applies to loan notes. So you can't be giving loan to yourself. You can't be, you are the owner of the company and you are saying that you are giving loan to them. No, you are just buying what they want for them. You are buying what they want for them because they don't have the money to buy whatever they want to buy. So you are buying that particular thing for them. So upon consolidation, the loan notes and those things must be what? Must be cancelled. We also have other issues. We don't have time, and I cannot go explaining the consolidation itself. The introduction to consolidation itself must take like maybe 1 hour. So we are here to do revision. Let's take question 1. Maybe if I'm solving the question, then I'll be explaining. Group accounts. Question 1. Do I have my reader here? Someone should read it for us.
Oh,
Question 1.
like I read for you, but I've not gotten to the house. That's why.
So I should send my phone to you so that you read.
If somebody can send me the document, I can read.
Send me how.
Okay, let me read.
Okay.
Okay, so below are statements of profits or loss and other details of 3 entities. Aflao, VP, and DIN for the year ended 30th June 2015. Statement of profits or
Hello, sir.
loss
Can you share the document with us?
He said what?
Can you please share the document with us?
Where are you?
I'm in Liberia.
Is that?
I'm in Liberia.
Which page? Like how did you get a link?
I'm part of the.
Please, I can't hear you. Okay, senior, move on.
Okay, boss. It's a statement of profits or loss for the year ended 30th June 2015. Additional information. So should I finish with additional info or should I read it one by one? Should we take it one by one after solving it or should I read everything?
No. Just that I don't even need additional information right now. I don't even need additional
Okay.
information right now. So the person who
Okay.
just said it, the person who is complaining about the document, send me hi. I'll forward it to you.
Okay, so revenue for Aflao is
Or leave that one. Leave the revenue and things. Let's just read the requirement for us. Let's take it from the requirement.
okay. So required. It says prepare consolidated statement of profit or loss and other comprehensive income for Aflao Group for the year ended 30th June 2015.
So from the requirement, we can identify that who is the parent.
Aflao.
Okay. So you just come and put your skeleton there. Yeah, just take it. Put your so you put your headings there. Aflao what? Aflao Group. Yeah, the person who is reading, you have to be very careful with the pronunciation because this is someone's what? Someone's hometown. So you have to be very careful with the pronunciation. All right.
Okay, boss.
All right. So we have our Aflao Group consolidated. You see, you are going to see some of the things over here which we have never seen in consolidation, but it's normal. It's normal. You don't have to know everything. And the pass mark is 50, isn't it? Okay. So
Yes,
yeah, that is why they made it 50 because you don't have to know everything. Okay. Statement of profit or loss and other. Please, my weakness is my handwriting, so you have to take it like that. for the
Oh, so
year.
it's nice.
You are not a lady, so I won't take it. For the year ending 30th, for the year ended 30th June 2015. Okay. So let's take our figures one by one. So are they in million? Are they in millions? Okay.
Yes, sir.
Okay. So the first item will be revenue. Are you okay? So the revenue you bring the parent home. The parent is Aplauso. The revenue will be 4,500. Just do everything before you count to who the subsidiary is. Put your skeletons there before you count to who the subsidiary is. What is the cost of sales for the parents?
3,000.
3,000. Then you count to gross profit. Don't bring anything. The gross profit is an automatic figure. If you do the workings for the revenue and cost of sales, the gross profit will come. So we don't do anything like you bring a gross profit 1,005. No, my brother, don't go and do that in the exam. All right. So just bring the gross profit. Don't put anything there. Then you have operating what? Expenses. How much for the parents?
456.
Okay. 456. All right. Hey, so this number of people are writing FR. Hey. Okay. We have investment income. So the investment income is how much?
90.
90. Okay. So that is 90. You can see that we don't have finance costs there, isn't it?
Yes.
You can decide to bring the finance cost. If at the end of the day there is no finance cost, you can put that there. Are you okay? But you can see that we have three entities over here. Let me give you this simple way of identifying who the parent is and who the sub. You see, the first entity will always be the parent. The first entity, the first company will always be the parent. The second one will always be the subsidiary, and the third one will be the associate. But if you are doing corporate reporting, the first will be the parent, the second will be a subsidiary, and the third can still be a subsidiary. But since this is FR, the third entity will always be the what? The associate. Okay. We don't have finance costs over here. You can decide to bring a finance cost. If at the end of the day, the footnote, you are not getting any finance cost from the footnote, then you put dash there. You don't have any.
Hello,
cost.
sir.
Yes, yeah.
So I want to ask, during the exams, can they put the question in such a way that you have to rearrange it? Because you see this one, it's already arranged. I want to know whether maybe they can mix it up for you to.
We have a way of
Yeah.
identifying who the parent is. So it is not compulsory or it is not automatic for you to identify.
I'm talking of from revenue to the profit or loss.
How?
Like I'm saying, maybe can they make it a way? Maybe they will just mix them up. Looking at how we are arranging it, maybe revenue will be somewhere, maybe below operating expenses, something like that. Like you,
So they are giving you that means they are giving you a trial balance. If they
okay.
make it like that, that would be a trial balance, but they cannot give you a trial balance for group accounts.
Okay, sir.
All right.
Thank you.
So you can decide to bring a finance income or finance cost rather. If there is no finance cost, then we put dash there. You can see that there is an associate there, isn't it?
Yes, sir.
Since there is an associate, there will always be a share of associate profits. There will always be a share of associate profits. So you bring that one too. Then you move on to the next one. You can see that they have given you your tax charge. You can also say, you can decide to show profit before tax. There's no problem with that. Or you can even go according to how they put it. Then you count your tax expense, which is tax charge or tax relief. Okay. Tax charge or the relief. The parent one is what?
120.
120.
120. Okay. We are not giving any other comprehensive income, but we now take the footnote and see what is going to happen there. All right. Let's come to the footnote A.
Okay, footnote A. It says on 1st July 2012, Aflao invested in 30% equity interest in Denum for 510 million Ghana cedis and has exerted significant influence over Denum since that date. Denum's equity share capital at current year end, which has not changed since acquisition, is 480 million Ghana cedis. Denum's reserves balances at acquisition were 600 million Ghana cedis, including other reserves of 120 million Ghana cedis.
All right. So what are they saying? They are talking about investment in associates, isn't it? All right. They are talking about investment in associates, and they are saying that on 1st July 2012, what is the current date? Our current date is what? Our reporting date now is what?
30th June 2015.
So it means that we have acquired these people 2 years or 3 years ago, isn't it? All right.
3 years ago.
So our interest in them is what? 30%. Okay, if there's no issues with impairment and other things, we can move straightforward to what? Investment or share of associate profits. If there's nothing happening there, we can move on straightforward to what? Share of associate what? Profits. So we know that our percentage holding in them is 30%. So it will be the 30% of any profit that they are making. We take 30% of any profit that they are making. So we can move on straightforward. If there's any issue there, sometimes there can be unrealized profit relating to them, impairment or anything, but we are going to show those ones in other places. So the share of associate profits will be 0.3 multiplied by the associate profit for the year. Associate profit for the year is how much?
246.
246. So they are making a profit of 246. We are going to have 30% of it, and other shareholders will have what? 70%. Let's move on to B.
Okay, B. It says on 31st December 2014, Aflao acquired 45% equity interest in VP. On this date, Aflao and VP remaining equity holders contractually agreed to allow Aflao to appoint and remove majority of the governing board members of VP, as well as to make unilateral decisions about VP's relevant activities. VP's equity share capital at current year end, which has not changed since acquisition, is 480 million Ghana cedis. VP's interim accounts for the first 6 months of the current year showed an after-tax loss of 84 million Ghana cedis. The purchase and sale agreement relating to VP's acquisition provides the following as consideration. This transfer of Aflao equipment having carrying value and fair value of 210 million Ghana cedis and 24 million Ghana cedis respectively at acquisition date. Issuance of 120 million equity shares of Aflao on 28 February 2015, 2 months after acquisition. The share price of Aflao was 6 Ghana cedis each at acquisition date, 8 at 28 February 2015, and 9 Ghana cedis at 30th June 2015. Aflao has not recorded the above considerations but has charged professional fee of 12.6 million Ghana cedis in respect of this acquisition against its share capital.
Okay. So what do we know? What do we know indicate control? What do we know? Just be sincere. If you want to say that this particular company is having control over the other company, what is the criteria that you normally use?
What I know, control exists when the parent holds more than 50% shares in the subsidiary.
That is what you know, isn't it? Okay. Thank God that is not what we know. That is what you know. All right. You see, in most cases, okay, in most cases, or for examination's sake, the control will always be more than.
Solanos.
Yes, please. Yes, I can hear you. Hey, see that this time around your network is still worrying. Okay. So I'll be waiting for you. Okay. What we know is that control is achieved. Sina, right? Are you talking? Okay. What we know is that control is achieved when there is what? More than what? 50, or there is 50 or more percent holding of the investor in the investee. But there can also be a case, or there can also be a situation where the investor is having less than 50%, but can still have control over the investee. What are those situations? You are having 40% of the ordinary shareholdings of a particular company, but the remaining 60% are being spread among what? 60 people. It means that one person will be having what? 1%. One person will be having 1%. In times of what? Decision making, or in times of voting, whatever you are going to say will carry weight than what each of those people will be saying, unless those people want to come together and form a force against you. Okay. This one, why? Is it like the Ghana Army people, they are going on operation, or is someone's network? Okay. So ideally, what we know is that control is achieved when there is what? 50 or more percentage what? Holding of the ordinary shares of one particular company by another company. But I'm saying that there can also be a situation where the person will be having less than 50%, but the person will still be having control. What are those situations? You are having 40% shareholding in a particular company, and the remaining 60% are being spread among what? A numerous number of shareholders. Let's say 60 people. In times of voting, or in times of you people agreeing on something, whatever you are going to say will carry weight than what the individuals, those 60 people, are going to say. So you are having 40%, someone is having 1%. So what I'm going to say will be having what? More power than what you having 1% is coming to say, unless the remaining 60 people want to what? Want to form a force. They want to come together. Unless those 60 people, they want to come together, where their force will be 60 against 40. But situation where they are not coming together, the one having the 40% will be seen to have a control over the what? Over the company. And you can see that the question, and you can read that the question has given us, the question knows that we know that 50% or more than 50% indicates control. That is why they have given you 45, and they are still giving you gist to know that 45% is indicating what? A control. The 45% is indicating a control. They say they have 45%, but they have the right to eliminate what? Or to remove what? People who are in what? Major positions. So if you don't have control over someone, how will you sack people without the consent of the other shareholders? So the question has given you enough information to tell you that although you know 45% does not give what? Control, but it is giving a control to what? To Aflao. So the question now is, what is the reporting period, and when was the acquisition done? What is the reporting period, and when was the acquisition done?
The reporting period is 31st March 2015.
Are you sure?
And the acquisition was on.
Are you reading your own question, or you are reading my own?
30th June 2015.
Okay. And acquisition?
And then that was on 31st December 2014.
So how many months?
So
The
that's
post-acquisition period is how many?
it's 6 months.
Okay. So what we do is that we what? We find only 6 months of what? The revenue of the subsidiary. We find only 6 months of the what? The subsidiary figures. So it will be 6/12. 6/12 times what? The revenue is what?
2880.
2880.
Okay. If you count to the cost of sales, it will be 6/12 multiplied by what?
2544.
2544. Okay. If you count to the operating expenses, that will give us what? 6/12 multiplied by
408.
408. Do they have investment income?
No.
Okay. But they have what? They have tax.
Relief.
Okay. So let me take this one off. So the relief, that is positive, isn't it?
Yes, please.
So we have minus. Do you know that it will be a deduction?
Yes.
You see that the parent's own is a cost. The subsidiary's own is what? It's a gain. So you subtract. So this will be minus what? 6/12 multiplied by 36. Are we okay there?
Yes, sir.
Okay. Let's now take what? Some of the things that they are saying. Let's now take some of the things that they are saying. Okay. They say their first equity share capital at current year end is what? Their equity capital at current year end is how much? The equity capital at the current year end, which has not changed since acquisition, is what? 480. Their first interim account for the first 6 months of the year showed an after-tax what? Loss of 84 million. Okay. The purchase and sale agreement relating to the first acquisition provides the following as consideration. So this information given to you over there is to help you determine what goodwill on acquisition, if the question is asking you to do that. Please, Abeg, if you are not talking, just put your mic off because you are giving me a bad signal. All right. All right. So those information given to you relating to the share capital, the profit, and those things, they are for calculation of goodwill. We just have to determine the net asset at acquisition. But let's move on. When we get there, we use them. Okay. The purchase and sale agreements relating to the acquisition provides the following as consideration. Transfer of Aflaos equipment having carrying value and fair value of what? 210 million and 246 million respectively at acquisition date. So instead of us paying by cash, we are giving them what? An asset. We are paying them in kind. We are paying them in what? In kind. So we are giving them equipment in return for the shares. What is the carrying value of the equipment?
210.
And how much are we giving it to them?
246.
So what is happening there?
There's a gain of 36.
Okay, there is a gain of what?
36.
Okay, how are we going to recognize this gain? Will it be to other comprehensive income, or we are going to send it to profit or loss?
Profit and loss.
Why are you saying profit or loss?
The question have already make a clarification that I think when you go down,
Which of the down?
the footnote.
Okay, which footnote? The one that they say the Aflao has not recorded the above consideration, but has charged professional fee of 12.6 million in respect of this transaction. Which of them?
No, not that
He's
one.
talking about the footnote.
Footnote what?
H, the last one.
Okay, the last one is saying what?
Yes.
It says
And the group includes depreciation,
the group
gain, and
includes
acquisition.
all depreciation, loss, and gain on asset disposal in cost of sales.
Okay, okay. Hey, senior, then it means that you have read this thing already. That is nice. That is nice. All right. This even if the question is say this, if this particular thing is not here, if this particular clause is not here, the clause is not here, what will happen is that the assumption is that the company has disposed of the asset and used the proceeds to purchase the what? The shares. So the company has disposed of the asset. The value of the asset was 210 and they have disposed it for what? 246. And they have used the 246 to purchase the what? The ordinary shares. So if the asset is 210 and you are disposing it for what? 246, it means that you are making a gain or a profit on the sale. So that particular profit will go to what? The statement of profit or loss. Even if there is nothing like this concerning that, you assume that the company has disposed of the asset and used the proceeds to purchase the asset, to purchase the shares of the company. So they are saying that this should be included in cost of sales. So if you go to cost of sales, what are we going to be doing? 36, which is the gain. What will you do? Subtract or add?
You subtract.
Okay, because the cost we are subtracting again from it. So that is 36. Okay, let's come here. So our first consideration is what? Transfer of what? Equipment, which is 246. Okay, issuance of what? 120 million equity shares of Aflao on 28th February 2015, 2 months after acquisition. The share price of Aflao was 6 cedis each at acquisition date and 8 cedis at 28th February 2015 and 9 cedi at 30th June 2015. Okay. You don't understand what? Gina, what?
Please,
Yeah.
the first part, I didn't understand the first point.
The transfer of the equipment?
Yes, sir.
That is an English. So which part of it? Is it the interpretation of the English or the sentence itself?
Yes, sir. I thought we do better first lesson.
Okay, they are saying that the transfer of Aflao's equipment. So we are buying shares. We are buying shares. It's just like you are selling. What do I need? What do I need? Do you have a DB in the house?
No, sir.
Okay, but let's assume that you are selling a DB and I don't have money to buy, but I have something that you also need. Okay, I have something that you also need. The thing that I have is the price of the thing is 20 cedis. Okay, but I'm saying that I will give it to you at 30 cedis. So it means I'm making a gain of what?
10.
10 cedis. So you have something that you are selling. I don't have money to pay, but I said I have something I'll give it to you. But to me, I know that the cost of the thing is 20, but I'm giving it to you at 30. It means I'm going to make a gain of 10. In the same way, the parent is buying the shares of what? The subsidiary, but they don't have cash to pay. So they have an asset with a carrying value of 210, but they are transferring this asset at 246 to the subsidiary
Yes.
shareholders. So it means that they are going to be getting a gain of what? 36 on this particular transaction.
Yeah.
And the question says that gains, losses on disposal of assets should be taken towards cost of sales. The cost of sales is already a cost, and we are taking a gain there. So the gain is an income. So if you are taking income to a cost, the income is going to reduce the cost. That is why we are subtracting.
Yes.
Okay. I hope I can now move on in peace. All right.
Yes.
Let's
Hello,
come.
sir.
Yes, Senior.
Please, which of the statements from the question says we should send them to the course of state?
Which of the statements?
Yeah, maybe the numbering, maybe footnote E of footnote this. I want to know that.
Okay, maybe if you meet the question in the exam, then you look for a footnote that says that.
By default, that's why you have to treat it.
It's not by default. Someone just said that it is the last footnote. Okay.
Okay, sir.
It is the last footnote. So you can see that they are saying that AFLAO has not recorded the above consideration. So it means that the transfer, the gain associated with the transfer, everything has not been done. But if the question says that they have already done this, it means that the gain has been recognized. But they say that they have not recorded any of the consideration. It means that they still have the asset in their books at 210. So you have to pay attention to it has been done or it has not been done. If it has not been done, then you do it. If it has been done, then you leave it because they have done everything already. All right, let's come to this one. In addition to the transfer of the equipment, what are they doing? They are also doing what we call a share exchange, isn't it? They are also doing what we call a share exchange. They are going to issue new of their ordinary shares to what? To the shareholders of what? The subsidiary. And they are giving 120. They are giving what? 120 shares. So that is a 20. That is the number of shares that they are giving. But what we need to know now is the what? What is the value of the shares that they are giving in terms of money? What is the money value of the shares that they are giving? We only know the number of shares that they are giving, and that is the 120 million. What is the value of the shares that they are giving? Which of the price are we going to use to value the shares? Which of the price are we going to use to value the shares? Which of the price?
6 series.
Okay. But read that one again and see whether you come with a CCD again. Issuance of 120 million equity shares of AFLAO on 28 February 2015, 2 months after acquisition. The share price of AFLAO was 6 cedis each at acquisition date and 8 at 28 February 2015 and 9 at 30th June 2015. So are you still holding on to the 6 or you want to change your mind? Sinabanga, are you still holding to the 6 or you want to change your mind?
I think we use the 8.
This is not the time to be thinking, to be saying I think. No.
Okay, sir.
That is the 6.
We'll use the 6.
You are still using the 6, isn't it?
Yes.
Why?
Yes,
Why?
sir, yes.
We will use the 8.
We will use the 8
Very interesting.
because the acquisition happened 2 months. The shares were issued 2 months after the acquisition, which was 28 February. So after 28 February, the share price was 8 cedis per share.
Okay. I'll think about your own. Abanga, why are we using the 6?
The 6 was on the date of acquiring the equity share in the VMP. So you have to use the original one. The date that AFLAO acquired VMP.
Okay. Okay. Although I'm not convinced, but I'll take it like that. This is not a time to be convinced. Someone is saying that I thought there shouldn't be a gain on transfer I thought there shouldn't be a gain on transfer between parents and subsidiaries. Someone is saying something like that concerning the gain of 36 million that we have recognized. Do you have anything for that person? Do you have anything for Stephanie? Do you have something to tell Stephanie that this is the reason why we are recognizing again? Abanga, do you have
Hello,
something to
hello.
say? Yeah.
This not okay. This not inter group training. This an asset that the parent is transferring to the subsidiary, but it's not an intergroup training whereby you said the train cannot make profit from the subsidiary. It cannot sell something to the subsidiary because
Okay.
the subsidiary is part of the group.
Okay. That is nice. Auntie Gina.
I think also this is relating to the purchase consideration. That's why I'm supposed to add.
Okay. That is nice. Yeah. Auntie Stephanie or Senior Stephanie. You see, the transfer of the equipment is not for the subsidiary. It is for the shareholders of the subsidiary. You're supposed to pay the people 246, but you are giving an asset which is what? Which is 210 for that. It means that you are getting a gain. Instead of you giving the asset to them at 210, you are giving it to them at 246. This is not for the subsidiary. It is for the shareholders of the subsidiary. You are not giving the asset to the subsidiary. You are giving the asset to the what? To the former shareholders of the subsidiary, who are no longer what? Owners of the subsidiary. So that particular transaction is between the company and the shareholders, the old shareholders of the subsidiary. It's not between the subsidiary and the parent. No. All right. Let's come to the shares. We are saying that we should use what? 6 cedi, 8 cedi. Which of them are we using? 6 cedi or 8 cedis?
6 cedis.
All right. It's not 8 cedis, it is 6 cedis. Why is it 6 cedis? You see, this particular issue is what we call share-based payment. If you come to corporate reporting, it's share-based payment. You see, not that the former shareholders of the subsidiary are not part of this, are not aware of this arrangement. The issue is they have agreed on this particular arrangement, but they are now saying that the shares supposed to be given to them. They don't want it now. Shares are supposed to be given to them in 2 months' time. But they have already agreed on what? On the share that will be given to them, and they have already agreed on what? On the price. So if you come to equity, equity will use the what? The value at the grant date, the value at the time that the transaction happened. So you are going to use 6 cedis, but just that they don't want to receive the 6 cedi multiplied by the 120 at the date of acquisition. They want to receive it after 2 months. So we don't use the 8 cedis. No, it's not liability. This is an equity which is not remeasured. So we use the value at acquisition to value the equity, and this will not change again. So we are going to use 6 cedis to value the number of shares that we have, not 8 cedis, not 8 cedis. Thank you. All right, but those things will be needed for maybe calculation of a goodwill or gain or bargain purchase. So let's ignore them and move on to the C. The C. Who is going to take the C for us?
Okay, so for the C, it is at the date of acquisition of VP, carrying value of its net asset was equal to fair value, except 2 items. The first relates to a contingent asset disclosed at 60 million Ghana cedis in VP's financial statement, which had an estimated fair value of 90 million Ghana cedis. At year end, this contingent asset is disclosed as 79 million Ghana cedis in VP's financial statement. The second relates to land property with its current value below fair market value of 300 million Ghana cedis by 60 million Ghana cedis. The recoverable amount of the property at 30th June 2015 was measured at 360 million Ghana cedis. Aflao Group accounts for all items of property, plant, and equipment at cost.
All right. Let's take them one by one. At the date of acquisition, the carrying value of each net asset was equal to the fair value except 2 items. The first relates to what? A contingent asset disclosed at what? 60 million in JFS financial statement, which had an estimated fair value of 90 million. I hope we know what we call a contingent asset.
Yeah.
Hope you know what we call a contingent asset.
Yes, sir.
What do we call a contingent asset? Zoom.
Okay, so it's a probable asset that whose confirmation can be that whose existence can be confirmed by the occurrence or non-occurrence of future uncertain event.
Example. I mean, I don't believe in the definition. Like, give me example so that I will know that you really understand what you're saying.
Or let's say if a company should sue maybe its suppliers for some warranties that or some damages that they've suffered due to the negligence of the supplier, and they said it is said that the lawyers advised the entity that maybe there's 80% chance of winning the case, then there's a contingent asset that they can disclose.
Okay. So contingent assets are not recognized, even if there is a 90% chance that you are going to receive it. No, we just disclose it. But if you come to business combination, now Aplau is coming to acquire Viaper. It means that Aplau will be taking Viaper together with the contingent assets. So if we are not putting the contingent asset in our books, and after acquisition, the contingent asset has now materialized, it means that Aplau will now be receiving that money, which we didn't take into consideration before selling the company to them. So at acquisition, business combination, all contingent assets, all contingent liabilities must be considered before valuing the company, because these are potential benefits or obligations that the parent is going to fulfill in the future. So although this particular item is not in the books of the subsidiary, therefore Aplau has to take this into consideration before placing value on the subsidiary. So they are saying that it has been disclosed at how much? 60 million, but the fair value was 90 million. You can see there's an increment at acquisition, isn't it? Okay. At year end, what is happening?
Reduce again.
Reduced by how much?
11.
11. So we are going to charge the 11 to operating expenses. At acquisition, it was 90. It has to be fair valued. At acquisition, it was 90. But during the year, it has now reduced to 79. There is a loss. There is a loss, which someone can say an impairment of the contingent asset. All right. So there is a loss. That particular loss will be sent to Will be sent to operating expenses. So we come and add 11 here because it's a loss. We are done with that. Let's count
Sir.
this. Yes, please.
They say you will send it to cost of sales.
They say that one also should go to cost of sales.
Yes.
Okay, sorry. So let me come and add it to cost of sales. All right. So the 11, I'll remove it.
Sir.
I'll remove it later. All right.
Hello, sir.
Yeah, senior.
Please, with the B, with the B, with the 12.6 million being the professional fees.
Yeah, we haven't tackled that one.
Okay.
We haven't tackled it, isn't it?
Yeah.
Linus.
Yeah. So
Hello?
let me take the 2.6. I didn't see the 2.6. All right.
Linus.
Yeah,
Sorry.
senior.
Yeah, the 11 you are adding to operating expenses and cost of sales. Is it the difference between the 90 million and the 79 million?
Exactly.
Okay, thank you.
So it should be added to holding cost of sales. So I've taken it from the operating expenses. All right. So the third point, Aplau has not recorded the above consideration, but has charged professional fee of 12.6 million in respect of this acquisition against its share capital. All right. The professional fee. What do you think might be the professional fee? what do you think will be a professional fee that they are going to incur during the acquisition? What of the items that can be classified or that can be qualified as a professional fee? Okay. All right. So the professional fee can be maybe before you want to acquire the subsidiary, you have now engaged what? Professional valuers to value the what? The subsidiary for you to know the value the worth of the subsidiary so that you pay. Or you have consulted some people that this is what we want to know or this is what we want to do. We want to acquire this particular company. Check and see whether this particular investment is profitable. Then you pay those people. All right. The standard says that any cost that is incurred relating to what? Acquisition of a subsidiary, all those costs should be what? Should be expensed. But not all of them. There's one of the costs that should not be expensed. What is that cost? If the company is doing share exchange, if the company is doing a share exchange where they are going to be giving the shares in return for what? The shares that they are buying, they are going to incur what we call issue cost. It's just like financial instruments. Whenever you are going to issue your shares, you are going to incur a cost. If there is an issue cost relating to the what? To the acquisition, that is through a share exchange. The issue cost should be treated in accordance with what? IFRS 9, financial instruments. But any other cost apart from the issue cost that is incurred relating to acquisition, that particular cost must be what? Expensed. That particular cost must be expensed. Therefore, the professional fee must also be expensed. But what are they doing? They are subtracting it, they are capitalizing it, they are subtracting it from their share capital, which is very wrong. If it should be an issue cost, the issue cost must be subtracted from what? The share capital. But any other cost apart from the issue cost, it should be expensed. So they are saying that the 12 million in respect of this acquisition against each share capital, it means that they have subtracted it from their share capital, which is very wrong. This should have been treated as what? As an expense. This should have been treated as an expense. So what we do now is that we go to the operating expenses of the parents, then we add the 12.6. That should be expense, not what? Capitalized. So you go and subtract the 12.6 from their revenue. Subtracting it means that you go and add it to the expenses that you already have. Are we okay with that treatment? Any expense apart from the issue cost, which is incurred relating to what? Acquisition, all those expenses must be what? All those expenses must be what? Taken to profit or loss for that particular year. But if it should be issue cost, the issue cost should be what? Treated in accordance with what? Financial instruments. All right. So we are done with that part. Senior, thank you. Thank you very much. Let's come to the contingent one. We are done with that part too. Some of these items will help us to know goodwill or impairment or something. Let's come to the second one. The second relates to land property with its carrying value below fair market value of 300 million by 60 million. So this is at acquisition. The recoverable amount of the property at 30th June 2015 was measured at 360. Aflawo Group accounts for all items of property, plant, and equipment at cost. So at acquisition, what is the value of the land property at acquisition? At acquisition, what is the value of the land property?
240.
It will be what?
240.
240. That is nice. 240. So at acquisition, the value of the property will be 240 because they are saying that the second relates to land property with its carrying value below fair market value of 300 by 60. So it means that the carrying value is what? 240 and the fair value is what? 300. Is that the interpretation?
Yes, sir.
All right. So the value has increased by what? At acquisition,
60
the value is
million.
60 million. So at acquisition, the fair value is 300. Okay. So the fair value will now become carrying value from the date of what acquisition. So it is land. The land will now be carried at 300 million. But at reporting, what is the recoverable amount of the land?
360.
Is there any impairment?
No, sir.
There's no impairment. We have 300 against 360. The recoverable amount is higher than what? The carrying value. So there's no impairment. Don't say that there is a revaluation gain. No, they say that the group accounts for property, plant, and equipment at cost. They are using cost model. So there's no revaluation. But at acquisition, the value has increased by what? By 60. Whether the subsidiary is using a cost model or a revaluation model, at the date of acquisition, all the assets and liabilities of the subsidiary must be fair valued. All right. So for that particular one, they are just giving you the recoverable amount to determine whether the asset has impaired or not. And we can see that this has not what? Impaired. Let's come to the D.
Okay, so to the D. It says Aflao transferred raw materials at their cost of 60 million Ghana cedis to VP in March 2015. VPS processed all these materials, incurring conversion cost of 30 million Ghana cedis, and dispatched them back to Aflao in May 2015 for 126 million. At 30th June 2015, Aflao had sold 84 million at transfer price to VP of these goods to its outside customers for 120 million Ghana cedis.
Okay, what is happening here? Intragroup what?
Finance.
Yes, Senior.
Sorry. The second relate to that land, the land listing is a PP item, and so is it not coming to the P&L since we have 60 cedis gain and we have some kind of 60 cedis loss or something like that? I don't. Will it come to P&L?
The items that we show in the P&L is post acquisition items.
Okay.
Post acquisition items. Is
Okay,
items
so this
that
one will not come to the
yes.
The P&L, right?
Yes, this is happening at the what? At the acquisition date.
Okay.
So we look at the items that we consolidate are post acquisition items. What are those transactions that happen after acquisition, not at the date of acquisition?
Okay.
All right. So Aflao transfer raw materials at the cost of what 60 million to Jeppe in March 2015. Okay. The time that Aflao is transferring these raw materials to Jeppe, how are they going to recognize this transaction? Are they going to recognize this as a sale, or how are they going to do it in their separate financial statements?
They'll use sales value.
No, the question specifically says that Aflao transfer raw materials at their cost of 60 million to Jeppe in March 2015. Let's look at this. So if the two of us, we are keeping records of what is happening, okay, assuming you are giving 60 million to your brother, okay,
yes,
the two of you are keeping records. You are going to recognize, assuming what you are giving to your brother is something that you can sell. So since you have transferred this thing to your brother, you are going to recognize it as sell, because the two of you are going to be taking records. Your brother will recognize that as what? Purchases.
Purchases.
Is that the case?
Yes.
Okay. So you are going to have 60 million in your books as sales, because you're also going to keep records of whatever is happening. And your brother will also recognize this as what? 60 purchases, because he's also going to take records of what you are bringing. So you can see that in the revenue of the parents, there will be a 60. In the purchases of the subsidiary, there will also be a what? A 60, isn't it?
Yes.
Okay. But this is a situation where there cannot be what? Sales within the group. So the Aflao is the owner of what? The subsidiary, which is Jeppe. So the assumption is that Aflao is buying the what? The raw materials for VFR, but they are not selling to them. So Aflao is buying the raw materials for VFR, but they are not selling to them. So what we'll do is that you can see that there is no profit on this particular transaction, isn't it? If
Yes.
there is no profit on this particular transaction, it means that it's going to have a zero effect on the profit. But since the standard says that there should not be any sales within the group, or the parents cannot sell to itself, which is a subsidiary. The parent is the owner of the subsidiary. So you can't buy raw materials and say that you are selling it to a company that you have or a company that you are the owner of. The best thing is that you are buying the raw material for that particular company. They don't have the resources to buy. So you are purchasing that particular raw material on their behalf. So what we do is that we go to revenue, we take 60, we count to cost of sales, we take 60. Why are we taking the 60, 60? Included in the revenue of the parent, they are having a sale of 60. Included in the cost of sales of the subsidiary, they are having a purchases of what? 60. So let's remove the two. Although if you don't remove it, it is going to have a zero effect on your profit, because 60 against 60 will give us 0. But because of ticks, go and subtract. Go and what? Subtract. Okay. Let's now come here. Let's now come here. Okay. Okay. So VFR process all of these materials in carrying what? Conversion cost of 30 million and dispatch them back to what? Aflao in 2015 for what? 126. In actual sense, what should have been the value of the goods that VFR should send to what? Aflao? In actual sense, all things being equal, what should have been the value of the goods?
90 million.
90 million.
It should have been 90 million, isn't it? But they are not giving to them at what?
126.
So it means that they are making a profit of what?
36.
36. So it means that VFR is now selling the what? The goods to what? Aflao, isn't it? All right. But there should not be any sale within the group. You can't sell to yourself. The best that you can do is that you should give the goods to what? To the other company to sell it on your behalf. You are not selling to them. You are just saying that we don't have enough market over here for this particular product. But since you people, you have enough market over there, we are giving these goods to you so that you sell it on our behalf. That is it. That is it. So the receiver of the goods, or the buyer or the receiver of the goods, is no way expected to make additional profit on the goods. No. If it is the parent that is giving the goods to the subsidiary is not expected to make a profit on the what? On the sale. It's not expected to make additional profit on the sale. No. They are going to make the sales on behalf of what? Of the parents. So let's now come here. You can see that there is an intragroup sales of what? 126, isn't it? There is an intragroup sales of what? 126. VFR is selling to what? Aflao at a price of 126. The standard says that we should remove all intragroup sales. So you take 126 from this place, you take 126 from this place. But this place should not be 126. It should be the cost relating to the 126. It should be the cost relating to the 126. But since we are taking 126, it means that we are subtracting more than we should subtract. And the way to neutralize that particular effect is to find the unrealized profit and add it back to your cost of sales to neutralize the excess amount that you are subtracting. All right, let's look at this one. Let's look at so the selling price of the goods is what? 126, isn't it? Okay, but Aflao has sold what? What is the value of the goods sold by Aflao?
84.
What is the value of the goods sold by Aflao?
84.
84. Okay, out of how much?
126.
126.
So there's some portion of the goods that were not sold, isn't it?
Yes, sir.
Okay, so unsold goods. What will be the value of the unsold goods? It's 42,
42.
isn't it?
Yes.
Okay. If they should sell all the 126 goods, they are going to be making a profit of 36, isn't it?
Yes.
But they have sold only 84. They are remaining what? 42. So the provision for the unrealized profit will be calculated as the remaining goods over the total value of the sales times the what? The unrealized profit. What are we getting?
So,
What is the value?
so,
2 of 1, 2.
yes.
Okay, so you go to cost of sales and add your 1, 2. This one you can. This is not the one that you have been using what percentages. This is not the one that you have been using percentages. No. This one, if you like, you can calculate your what your profit margin. If you like, you can calculate your what your profit margin. The profit margin will be calculated as the 36 over 126. That will be the profit margin. So any figure that you are going to get, you just multiply this one by 42. All right, that is the margin. If you want to calculate your margin, is 36. The profit over the what? The selling price times what? 42. That is the margin. That is the margin. So so this will be multiplied by 100. If you want to get a margin, it will be this multiplied by 100. But if you want to get unrealized profit, it will be 36 over 126 times 42. Another way of going about it is this one. Okay, if you sell all the 126 goods, you are going to be getting a profit of 136, of 36 rather. But you are not able to sell 42. So what will be the profit relating to this one? Then you do your simple mathematics and move on. So the unrealized profit will be 12. We are done with that side. Let's move on to the E.
Okay, to the E, it says on 1st April 2015, VP and Denu bought 10 million and 5 million equity shares of Bulsa, respectively, at price of 12 plus 1% transaction cost. Both VP and Denu elected to account for the investment as financial asset held through other comprehensive income. These investments have not been updated at current year end. Fair price of each Bulsa's equity share at year end was 10.8 Ghana cedis. Total number of Bulsa's equity shares is 100 million. Both entities had not earned any other comprehensive income prior to 1st April 2015 within the current year.
All right, that is very nice. What are they talking about over here? Which standard is this?
IFRS 9.
Okay. So this is what? Investment in what? Is it investment? Is it investment in equity? Is this an investment in equity? This will be a financial asset, isn't it?
Yes, yes.
Okay, financial asset through what? Investment in equity, isn't it? We have financial asset through investment in debt, where the company will be buying what? Bonds of another company. That is investment in debt. Okay, but the company can also be buying shares of another company. That will be treated as what? Financial asset, but this is through investment in equity. So if it is investment in equity, financial asset through investment in equity, the classification of the instruments are two. The first one is through profit or loss or through other comprehensive income. But this particular one, the classification is through what? Other comprehensive income. If it is through other comprehensive income, how would the instrument be initially measured? We take the fair value, then we capitalize the issue cost. The meaning is that the asset will not be sold now. It is through other comprehensive income. So we don't have any intention of selling it. So the transaction cost will not be consumed within a year. It will be consumed within what? Some number of years. So we capitalize the cost. So let's calculate the value of those things for each of them. Let's calculate the value for each of them. Okay, let's calculate the value for each of them. So let's look at our flow. Let's look at them. So what will be the number of what? shares that they have bought. Number of shares. Aplau is 10 million, isn't it? Aplau is 10 million. Vieper,
It's VP.
Yes, we paid not.
VP and then
if no, I'm coming in. Okay, if Vieper and what? Okay. All right. So Vieper number of shares is what? The shares that they have acquired is 10 million, and Denu is what? 5 million, respectively at a price. So what is the price per share?
12 cedis.
So price per share is what? 12 cedis. 12 cedis. What will be the initial value? What is the amount that they are paying?
120.
This will be 120, and this will be 60, isn't it?
Yes.
But they incur a transaction cost of what?
1%.
So the transaction cost will be capitalized, and this will be 1.2. This will be 0.6. Is it 0.6 or 0.06?
0.6.
0.6. Okay.
Yes.
So let's now find their total value.
One, two, 1.2.
1, 2, 1, 3.
1.2. So 1 to
1 to 1.2.
Are you sure?
So it's 120
Yes.
plus. It's
1 to
120 plus
1.2.
1.2.
Okay.
Yes, please.
1 to 1.2. And this one give us what?
60.6.
60 point what?
6.
Okay. A minute. Let me send a document to this person. 64. 64. Okay, so these are their initial values. These are the initial values. But what will be the value at reporting? What are they saying about the reporting? What is their value as reporting? What is the value are we giving as reporting? What is their values?
10.8 per share.
So let's now find the value at reporting. So value at reporting figures. So reporting figures will be the same 10 million multiplied by 10.8. Am I correct?
Yes, sir.
Okay. And this will also be 5 times 10.8.
Yes, sir.
What will be the reporting figure for Vieper?
108.
108.
Yes,
Okay.
sir.
This will be 108. So there will be a loss, isn't it?
Yes.
A loss of how much?
13.2.
13 points. 13 point what?
0.2, sir.
Okay. Let's come to the other one. What will be their reporting figure? Yeah, Victoria. Victoria, your hand is up.
Yes, sir, please. Yes, please. Please, can you hear me?
Loud and
Yeah,
clear.
with the equity investment, I thought that transaction cost supposed to be expense. So
How are they classifying the instruments? The two entities, how are they classifying the investments? Auntie Victoria,
they are
can you?
classifying it through OCI.
So through OCI, the transaction cost is no expense. We only expense transaction cost if it is through profit or loss. Profit or loss means that the instrument is likely to be sold within a year. So the cost will also be consumed within a year. That is why we expense it. But if it is through other comprehensive income, it means that the instrument might be there for more than a year or 2 years or 3 years. So the transaction cost must also be consumed over the number of years. So we add it, we capitalize it. So it's only profit or loss that we expense it with the mindset that the instrument is likely to be disposed of within a year. Therefore, the transaction cost should also be consumed within a year. That is why we expense it. But other comprehensive income and amortized costs, we don't expense, because the instrument will be there for more than a year. So the transaction cost must also be consumed over that number of years. Okay, I hope you're okay now. Let's move on to. So what will be the reporting figure for Denu? What will be the reporting figure for Denu?
Yeah, 54.
54. What will be the loss?
6.6.
6.6. Okay. And this loss will go to other comprehensive income, isn't it?
Yes.
Okay. Other comprehensive income, which is OCI. But let's come. When was this thing done? When are they doing the investments?
On 1st April 2015.
So that is after what? After acquisition. So other comprehensive income. So, okay. Other comprehensive income. Let me take these things off. Okay, so let me take this one to off. So we are going to have profit after tax. Then we now have other comprehensive income. Other comprehensive income. Under the other comprehensive income, we have a loss on financial assets. Okay, so the financial assets. So the loss, which of them will come here fully? Which of them will come here full? Which of them are we going to bring here full?
13.2.
13.2 will come here fully. And the other one, what percentage will come here?
30%.
It will be 30%. So 0.3 times 6.6. Are we correct with that? Because the associate, we are having only 30% shareholding there. So we find our portion of the loss. But for the subsidiaries, because the subsidiary is part of the group, and this particular 13.4 is relating to post-acquisition period. So we don't prorata this one. Don't say that it's 6/12. This has not happened at the start of the year. It happened after acquisition. After acquisition. So this will be a full loss will be charged because this happened after acquisition. All right. We are done with that particular side. Let's come to the E. Let's come to F rather. Let's do with the F. I won't add the figures for you. So after I've done the adjustments, you add your own figures. Okay.
Okay, so F, it says both Aflao and Dino have correctly accounted for Dino's dividend in their separate financial statements. Aflao has included its share in investment income.
So that Denu is what? Denu is what to Aflao? Denu. Is a Denu the subsidiary?
Associate.
Denu is the associate, isn't it?
Yeah.
Okay. So the share of the associate profit. The share of the associate profit already included what? The dividend, because we are sharing profit before what? Dividend, isn't it? So if you go here, what is over here? We are having 30% of what? The 246, isn't it? And the 246 is the profit for the year before taking into consideration the dividends. So if we are having a share of the 246 at the same time having a share of dividend, it means that we are having a share of dividend twice. We are having a share of dividend twice because the dividend is already part of what? The 246. So the profit that you should have shared should have been the what? The profit after dividends. So dividend is paid out of profit. So if you are having the share of the entire profit, the same time the dividend, it means that you are having a share of the dividend twice. You are having a share of the dividend what? Twice. What is the dividend paid by the what? The associates. The dividend paid by the associates is how much?
60.
Is 60. So what will be our share of that? What will be the parent share of the dividends? Would that be 0.6, 0.3 times 60? Would that be 0.3 times 60? Would that be 0.3 times 60?
Yes.
And that will give us how much?
18.
Is how much?
18.
18. Okay. All right. This 18 is already part of the 246 that we are receiving. Because dividend is paid out of what? Profit. So if you are having your share of the entire profit, it means that you are having a share of the profit, including the dividends, because the dividends will be paid out of the profit that you already have a share of. If you have the share of the dividend again, it means that you are having a share of the profit relating to the dividend twice. You have taken a share before they have paid the dividend, and you are still receiving the dividend again. That is what? A duplication of what? Recognition of revenue. So what we do is that the investment income, you come and take the dividends out of it because the dividends is already part of what? The share of the associate profits. The dividends is already part of the share of the associate profits. So you count the investment income, then you take your dividends out of it. All right, this is the only thing relating to that footnote. Okay, let's come to the G.
Okay, so the G is of Laos policy is to credit any bargaining gain on purchase of subsidiaries to operating expenses. No impairment charges had been made against investment in Deno in previous years. At current year end, an impairment review carried out on the investment in Deno showed that its recoverable amount was 620.4 million Ghana cedis.
Okay. Okay. All right, that's nice. Let's come here. What are they saying? You can see that they are not talking about goodwill, isn't it? They are not talking about negative goodwill or a positive goodwill. So the negative goodwill is the one that we call a gain on bargain purchase. All right, so let's now count to the calculation of a goodwill to see whether it is a gain on bargain purchase or it is a positive goodwill. All right. It is the last one, the H, under the H, you see other relevant details there. That is why you see the dividends. Okay. So how do we calculate a goodwill? Goodwill is calculated as the difference between the purchase consideration and the net asset that the parent is what? Is buying. And the net asset that the parent is buying. So what is the purchase consideration? What is our purchase consideration? Our purchase consideration is settled in two ways. The first one is transfer of what? Equipment, isn't it? And that was 246. We have already taken that one. That was 246. So we have transferred this one 246. And there also a share exchange or issue of shares. And that will be 120 times 6. That will give us how much? 120 times 6 is what? 720. Okay. What are we going to have now? Let's total it. Are we having 966? All right. Then we start with our net assets. The question now is, what portion of the assets are we buying that we are paying 966? We start with the net asset. We use the equity method. So we start with the share capital. What is the share capital given to us? 480. That is the current year end, but this has not changed. For the share capital, it will not change. So always the one given to you at the reporting figure will be the same as what? At the beginning, because we want the parent to maintain the same percentage holding. So if there is a change in the share capital or the number of shares, it means that the percentage holding of the parent will also be changing. So we want 70 from the beginning, 17 to the end. So there will not be any movement in the what? In the share capital or in the ordinary shares. If there's a movement, the movement might either cause the percentage holding to decrease or increase. So there won't be any other movement. So the reporting figure will always be the acquisition figure, and that is 480. Are we giving a return earnings?
Yes.
Are we giving return earnings? Are we giving return earnings? Can we know the return earnings at acquisition?
Yes, please.
The one given to us is as reporting. Can we be able to determine the acquisition figure?
Yeah.
All right. Let's try that. You can see that they are saying that the question is saying that what? The question is saying that the Vietnam interim account for the first 6 months of the current year showed an after-tax loss of what? 84, isn't it? Okay. Let's count to the loss for the year. What is the loss for the year?
36.
36. Okay. The loss for the year was 36, isn't it? Okay. Can we say that you can see that down, the H, that down there, you can see information on return earnings and those things, isn't it? Can we see information concerning the return earnings and other things there at the down?
Yes.
Okay. Can we say that the 1524, can we see the 1524 is relating to the subsidiary?
Yes.
Can we say that the 1524 over there, it was gotten after subtracting the loss of 36 from it?
Exactly. Yes.
Okay. So you can see that the return earnings, the closing figure will be gotten as the closing figure. They are going to get the closing figure, the closing return earnings, Please, if you are not talking, just put your listing off. We are not here to know where you are coming from or where you are going. No, we are here to learn so that you pass your exam. All right. So the closing will be calculated as the opening balance, which we don't know. Then we add profit or loss for the year to it. Profit or loss for the year to it. And that was a loss of 36. If there's any dividend, we subtract. But the subsidiary has not paid any dividend, isn't it? The subsidiary has not paid any dividends. Are we correct with that? All right. So this has now given us 1524. This has now given us 1524. So how do we determine the opening balance? The opening balance will be determined as the X minus 36 is equal to 1524. So opening return earnings minus the loss for the year, then will give you the closing for the year that we have. Then we have X is equal to 1524 plus 36. So this will give us what? That will give us how much?
You subtract
1560.
1560.
Someone is saying we subtract what and what?
1560.
Someone is saying we subtract something.
And
It's
he's
one
talking about the loss of
1560, isn't it?
yes, please.
Okay, so this is the opening value, isn't it? This is the
Yes.
opening return earnings. But this will be from July 1st. But we didn't acquire these people July 1st. We acquired them 31st December. It means that we have acquired them 6 months after the what? After the start of the year. So the return earnings at the date of acquisition will be the return earnings at acquisition plus the profit for that 6 months. So what is the profit for that 6 months given to us? The profit for that 6 months.
84. It's a loss of 84.
A loss of 84.
So our return earnings at acquisition will be 1560 minus 84. What are we getting?
1476.
14 what?
76.
1476. All right. Are we okay with that?
Yeah.
Okay. Should we use another way of calculating the 1476?
Yes. Yes.
Okay.
Yeah.
Okay. Look at this one. The loss for the first the first 6 months is what? It's 84, isn't it?
Yes, it is.
But the total loss for the year is now 36. What is the meaning of this? It means that during the last 6 months there was a profit, isn't it? It means that during the last 6 months there was a profit of what? There was a profit of what? You are having a loss for the first 6 months, but the full year you are now having a what?
48.
There was a profit of 48, isn't it?
Yes, sir.
All right. There was a profit of what? 48. What are you going to do with this 48 now? What you are going to do with the 48 is you either decide to add the 36 to the 1524. You either decide to add the 1524 to the 36. You either decide to add it to that one, then you subtract the 84, or you take your 1524. You take your 1524. You take your 1524. Okay. Taking the 1524, the figure that you have added was how much?
84.
The figure that we have added what?
36.
36. Okay. You have added 36. But the actual profit was what?
48.
48. So how much is the excess amount?
Yeah, I don't understand this.
Okay. Okay. Let's use the first one. I hope you're okay with the first one.
Yes.
Okay. Let's move on with the first one. Okay. This is what I want to say. Okay. This is what I want to say. Maybe if I use mathematics, that would be better. Okay. We know that the opening balance is this, isn't it? Okay. This opening balance, we have minus 84. So if you have the opening balance minus 84, it will be the opening balance minus what? The 84, which is the first 6 months. Okay. Then we now add what? 48 to it. Then we have 1524. This is how the 1524 was gotten. We have the opening balance, then the profit for the what? The loss for the last 6 months will be added. Then the profit for the loss for the first 6 months will be added. The profit for the last 6 months will be added. So it will now be the x minus 84 plus 48. If you do it well, you will still be getting the 1560 before you subtract the 84. Before you subtract the 84. Or what you do is that you have this one, x, you have your x minus 36, which is the same as what we have done. Then we have gotten that one. Okay, there's no problem with that. We are not here to do math. Let's move on. All right. So we are going to have fair value adjustment, isn't it? Fair value adjustment. We are going to be having a fair value adjustment. So the fair value adjustment, the first one is what?
Contingent asset.
Okay, there is a contingent asset. And that is how much? That will be how much?
90.
Okay. Then if you come to the land, what will be the fair value adjustment?
300 minus 240. That will be the 60.
That will be the 60. Don't take all the 300. They have recognized the asset in their books at carrying value. It is only the increment that they are here to what? Recognize. But if you look at the contingent asset, it has not been recognized at all. So we bring the total fair value. Okay, we bring the total fair value. We bring the total fair value. All right, we bring the total fair value. It's very interesting. Okay, you don't worry. We can even close at 11. Don't worry. So I'll do the ratio Friday. Tomorrow we are not going to meet, so we do it on Friday. We do the final account and some standards on Friday. All right. So the transfer will be 246.
Sir,
Yes, please.
if the next asset, why didn't you bring the realized profit if the staff was the one that saved the parent?
This is at acquisition. The unrealized profit will have no effect on acquisition. The unrealized profit will be included in the profit for the year, which is always in the what? In the reporting figure. So at acquisition, there was no sales. So, all right. So transfer of equipment. All right. So let's now come here. What is the value of the net asset?
Have it. Other reserve.
That would be what?
Other reserves.
There is no other reserves for the subsidiary. Or you can see some. There is no other reserve for the subsidiary. The other reserves is for the associate.
Other reserve 204.
They have other reserve 204.
Yes.
Oh, sorry. Other reserve 204. And that is at what? What date is that?
At 30th June 2014.
So we acquired them at what? 31 December. So the question now is, was there any movement in other reserves before acquisition? Were there any movement in other reserves before acquisition?
No.
There was no movement in the other reserves before acquisition. There was no other movement in the other reserves. I didn't see the other reserves, sorry. So that reserves is 204. And this is at the beginning of what? The year. But there was no movement in other reserves. So if there's any movement, we subtract it. If there's any movement, we subtract it. But there was no movement in other reserves. So we assume that the other reserves was 204 at acquisition and the same as the beginning of the year. So what will be the total net assets now?
2310.
2310. Okay, how are they calculating the NCI? How are they calculating the NCI? Applicable measures non-controlling interest at their proportionate share of the acquiree's what? Identifiable net assets. So what is the percentage holding that we are having in the subsidiary? What is our percentage holding?
45.
45. So if we are sharing the asset based on percentage holding, what will be our portion of the net assets? So the parent share of the net assets. The parent share of the net asset will be what? 45% of the 2,310. That will give us how much?
1039.5.
Is what?
1039.5.
1039.5. So the asset that we are receiving is 1,039.5, but we are paying what? 9,666. What will be the difference?
73.5.
73 point what? 5. Is this a good deal?
No.
Is a gain on buy gain purchase. Is a gain on buy gain purchase. And the question says that a gain on buy gain purchase is what? Applause policy is to credit any gain, any bargain gain on purchase of subsidiary to operating what? Expenses. So this 73.5, where will it go? It will go to operating expenses. So if it is coming to operating expenses, it will be a reduction, 73.5. Are we clear with that one? Yeah, I can hear you. Are we clear on that? Can we move on?
Yes, please.
All right. So do you have any other issue to adjust? Yes, we have one. No impairment charges have been made against investment in Denu in previous years. At current year end, an impairment review carried out on the investment in Denu showed that its recoverable amount was what? Its recoverable amount was what? 620.4. So that is, they are asking you to test for impairment on the associates. So impairment on the associates. So they are asking you for the impairment on the associates. The impairment on the associates. All right. The impairment on the associates. So let's now go. How do we determine the impairment on the associate? We determine this by showing investment in associate using the equity accounting method. So investment in associates. So we do this by saying investment in associates. All right. So the investment in associate, we start with what? The amount that we pay for them, isn't it? It's just like the money that you are putting in the bank. Just like the money that you are putting in the bank. So you go there, you put this amount of money in the bank. At the end of every year, interest the amount will attract interest. So let's look at the fair value at acquisition. The fair value at acquisition. And that was how much? How much did we pay for them? The first footnote. Okay.
510.
I didn't calculate NCI. I calculate the parent share of the net assets. I didn't calculate NCI. So I just calculate the parent share of the what? Of the net asset, not the NCI. I ignore the NCI. Okay. So that would be 510. All right. Okay, this 510, what will happen? What will increase the 510? It will be the share of the associate's profit, isn't it? All right. Let's come to the associate. Information concerning the associate. Okay. What is the equity capital has no effect? What is the what? The reserves of the associate. At the date of acquisition, what was their reserves? At the date of acquisition, what was the reserves of the associates?
780.
7 what?
80. No. 90.
The associate, the reserves at acquisition, the figure that you are getting over there is reporting figure. At acquisition, the footnote A.
600 million.
It's what? 600, but that is including what?
120 for
120,
reserves.
120 reserves. Okay. So we can also do this one directly straightforward without saying anything. Let's look at the other results of the two. Let's look at the other results. At reporting, what will be the other results?
At report.
192.
That is not at reporting. That is the beginning of the year, isn't it? All right.
Yeah.
So that would be 192. What is their retained earnings now? What is their retained earnings? So let's take the share of the
780.
associate profits. So we are going to have 780 plus 192. What are we getting?
180.
Plus 192.
972.
972, isn't it? But included in this 972, there was a loss on what? There was a loss of what? 6.6. Can you remember this loss relating to the financial assets? You can see that that was not captured in the other reserves. The loss of 6.6 was not captured as part of the other reserves. So this 6.6, as a result of the what? The investment in other company or other entity, was not captured as part of the other reserve. That is why they are having the 192. And the question also said that they have not what revised their what? Their investment. So this 6.6 was not captured. So we come and now find our new reserves now. This will be 972 minus 6.6. Then we subtract 600 from it. Subtracting 600 from it will show the what? The post-acquisition profit made by the associate. Then the parent will now have 30% of that. That will be the share of the associate profit. We have already taken the dividend out because dividend will be subtracted from the retained earnings before getting this figure. So we have taken the dividend out already. So in actual sense, the other result should have been 192 plus 780 if there was no loss relating to other comprehensive income. But there was a loss of 6.6 on the what? On the financial asset, which has not been taken into consideration before getting the 192. So you have to take it from the 192, then you add it to a 780. This is the what? This is the retained earnings from the date of acquisition to today. What was the value before we acquired them? It was 600. Then we subtract the 600 from this figure and see what was the post-acquisition profit made by the associate. Then we now find our share of it. So let's find it one by one. Yeah, Abanga, your hand is up.
Sir, please, how do you get the 972?
It's 192 plus 780. The last footnote there.
Okay, thank you.
I hope we are fine now. Okay, what is the figure that we are getting? What will be the share of the profit?
1092 109.62.
So 109.62. Let's add it. Let's add and get the investment in associates.
619.62.
619.62. Okay. This is the investment. But what is the recoverable amount given to us? The
20.4
is 620.4. So is there any impairment?
No.
No. So there's no impairment on the associate. So we are not going to do anything. That is all about this question. That is all about this question. So you add your figures. After getting this one, then you add your figures. So the task charge, we have done that. You will now add your figures and get whatever you want to get. All right. Let's look at the 972. Look at the down, the H. You see the other results. Then you see they are all under the company one by one. So the last one is under the associate, and you have their retained earnings 780. So 192 plus 780. 192 plus 780. What are we getting? Let's look at the question number 2. Question number 2.
Can you please turn to the next page?
Is that?
Can you turn to the next page?
Can I move to the next page?
The next place.
Question number 2. Who is reading?
Okay, question number 2. It says Sun acquired 600 million equity shares in Moon on 1st April 2016. The purchase consideration was made up of a share exchange of 1 share in Sun for 2 shares in Moon, the issue of 100 Ghana cedis 10% loan note for every 500 shares acquired, and a deferred cash payment of 11 pesos per share acquired payable on 1st April 2017. Sun also incurred directly attributable cost of 2.4 million on acquisition of Moon. This cost comprised 1.4 million cost of issuing own shares, charged to operating expenses, 1 million due diligence costs included in the carrying amount of the investment in Moon, and Sun's own statement of financial position. Sun has only recorded the issue of loan notes. The value of each Sun share at the date of acquisition was 75 pesos, and Sun has a cost of capital of 10% per annum. The statement of financial position at 31st March 2017 are shown below. Required, prepare the consolidated statement of financial position for Sun Group as at 31st March 2017.
Thank you.
Welcome, boss.
So who is the parent?
Sun.
So you can start by putting your skeleton there. You can start by putting your skeleton there. So you can start with the skeleton. So the PP. So you can see that we have only 2 entities. So we can start adding the 2. So we have 639 plus what?
340.
Okay. You can. Yeah. I'll upload the video on YouTube. So you can WhatsApp me. I will send a link to you. Then you go and watch. All right. Or I even have a page that is IFRS masterpiece. Some people who are here, they know very well. And like there are a lot of things that you don't know. You just memorize the standards. You don't even know what they mean. Okay. So if you want to know more about the standards, you can follow me. Okay. Life is not always about exams. Okay. You can decide to bring the investments. My number is in the link that you used to join. There's a contact number there, 008. All right. So you will the investment can be the money that the parent is paying for the subsidiary, but in whatever case, try to reconcile the investment. Try to see whether the investment figure that you have over there is the same as the amount that the parent is paying for the shares of the subsidiary. So you can decide to bring the investment first, then you reconcile and see whether all of them will cancel. So the investment is what? 121, isn't it? All right. Let's count to what? Intellectual what? Intellectual property. That is how much? Intellectual property is 30, isn't it? Then we have a goodwill. Okay, goodwill will come. If you're not sure, then you leave like 2 lines or 3 lines and move on to the next page and have current assets. And have a current asset. Okay, under the current asset, what do we have? The current asset, they just put all of them together. So we don't even have to. So what is the current asset? What are we having?
160 plus 70.
160 plus 70. Okay, then we come to equity and what? Liabilities. The equity items of the subsidiary will not come again, because the equity items of the subsidiary, the ones that they have before acquisition, will be cancelled by the investment that the parent is having in the books. So you can see that if you are preparing consolidated statement of financial position, we cancel the parent's investment. We don't bring it again, and we don't bring the equity. The equity is cancelling the net asset at acquisition, is cancelling the investment in the what? In the subsidiary. The difference will be the goodwill. The difference will be the goodwill. That is how we recognize the goodwill. That is the net effect. So we don't bring the equity items, don't add the equity items. The only equity items that will come will be for the parents, and that is what? 300. So you put 300 there. The retained earnings, we do workings for it. So you can put the retained earnings there and go. Do they have other reserves? No. So the next item that will come will be non-controlling interest. So non-controlling interest. So after the non-controlling interest, we have non-current liabilities. We have non-current liabilities. Another non-current liabilities, what do we have? We have
10% loan note.
10% loan notes. That is how much? It's
120.
120 plus 20, isn't it? All right. Then we come to current liabilities. The current liabilities, how much are we having? 200 plus 80. All right. So we can now take our question now. We cannot take the question. We cannot be in the position to take the question. I'm saying that whatever is going to happen, your first working should be the group structure. Your first working should be the group structure. So the group structure, you show how the composition, the group composition, and I hope all of you can do that. Then you write the date of acquisition. You write your date of acquisition under this one. You write your reporting date under the group structure. Then you write your post-acquisition period. The post-acquisition period is from the time that the parents acquire the subsidiary to the reporting period. How many months or how many years is that? That is a post-acquisition period. Let's look at the question from the top. Sun acquired what? 600 million equity shares in Moon on 1st April 2016. So the acquisition date is what? 1st April 2016. What is the reporting period?
From the question.
What is the reporting period?
Yeah, the first March 2017.
So that is a full year acquisition, isn't it?
Yes.
Okay, that is a full year acquisition. Let's come. That is a full year acquisition. Let's come to how is the consideration settled. So the first thing that we have to, the second working should be your net assets. So your net assets, we show your net assets. So the net asset we show at acquisition and at reporting. So you show your figures here, Then your third working should be the calculation of goodwill. Calculation of goodwill. Okay. So let's calculate the consideration. Those first information over there will tell us how to calculate the goodwill. So let's read the top there. The purchase consideration was made up of what? So let's come to the purchase consideration. The purchase consideration was made up of,
Share.
the first one is a share exchange. Okay. What is a share exchange? How is a share exchange done? How is a share exchange done?
There's
One
one
share
example.
is in for
One for what? Every two, isn't it?
Wow.
Yes.
What is the meaning of that? One for every two. What is the meaning?
1/2. 1/2.
It means
I'm not saying how it will be calculated. I'm saying what is the meaning?
it means for every 2 shares of Moon, Sun will issue one in exchange.
Okay. Okay. That's nice. Okay. The meaning is that bring two of your existing shares for one new. So bring two of your existing shares that you have in the subsidiary for one new shares in the parent. So this will always be calculated as the 1/2 times the number of shares that the parent is acquiring. What is the number of shares that the parent is acquiring?
600 million.
So if you want to bring the 600 million shares and you bring two of the 600 shares for one, they are going to be bringing 300 million shares. So that will be 1/2 times 600. So they are going to be getting 600 million shares. But the question is, what is the value of these shares? What will be the value of the 300 million shares that they will be having in the parents? We are only concerned about what? The value of the shares. What will be the value of the shares that the parent will be giving to them?
75 pesos.
Where did you get the 75 pesos from? Okay, the value of Sun share at the date of acquisition was 75. So you always value the share at the parent share price, because it is the parent that is giving the share to them. So these shares will be valued at the parent share price. So that will be multiplied by 0.75. Are we okay there? What are we getting?
225.
225.
225. Okay. 225. The second consideration is settled as what? How will the second one settle? What will be the corresponding entry for this particular one? We debit investment and credit what? What will happen to the shares
Credit
of the
equity.
parent?
You
What will
credit
happen to the
equity.
yes? The shares of the parent will increase because they are issuing additional shares. They are issuing additional shares. The best way to understand this is that you assume that the parent has issued the shares to the general public for 225, and the general public has subscribed to the shares. So they receive the 225. So the double entry will be debit cash, credit the equity. And they have used this 225 to purchase the ordinary shares of the subsidiary. So if you purchase, that will be what? Debit the investment, then you credit cash. So you first assume that the parent has issued the shares for cash, and they have used the cash to what? Purchase the shares of the subsidiary. So they issue the shares for cash. What will be the double entry? It should have been debit cash, credit equity. And they have now used this cash to purchase the shares. So it will now be what? Credit what? Cash, and debit what? Investment. So you can see that we are debiting investment and we are crediting equity. That particular movement in the cash will be zero. That is why we are not concerned about the cash. All right. So the equity shares of the parents will be increasing by what? 225. Okay. Let's move on to the next one. Let's move on to the next one. The issue
Okay.
of what? The issue of what? The second one is the issue of what? 110% loan note for every what? 500 shares acquired. So we will give you a loan note, but this loan note, you will bring what? 500 of every shares that we have acquired for what? 100 cedis. you bring what? 500 of every shares that we have acquired for 100 cedis. What is the value of the shares that we have acquired? What is the value of the shares that we have acquired?
600.
So we have 600 million divided by 100, divided by 500 rather, not 100. Divided by 500 times 100.
100.
The 100 is the value of the shares. Or if you like, you can also do it. You can write the 600 million in full. 600 million divided by what? 500. Then you now multiply by 100 and now change the answer to million. And now change the answer to million. So what are we getting?
120.
One what?
120 million.
Okay. That will give us 120 million. I hope you're okay with that particular calculation too. All right. A deferred cash payment. You can see that one particular question, they are using almost three means of what settling the consideration. So we have a deferred what cash payment of what 11 pesos per share acquired, payable on 1st April 2017. In how many years' time are we going to pay this amount? In how many years' time are we going to pay this amount? We acquired them on 1st April 2016, and we are paying the money on what? 1st April 2017. In how many years' time?
1 year.
1 year. So the question is, we have to know the amount that we are going to pay in that 1 year time. So the cash consideration, the deferred consideration will be what? How do we calculate it? That will be 0.11 times 600, isn't it? Because we are paying 11 pesos per the share acquired, and we have acquired what? 6 million shares. So what will be the value that we pay in the 1 year's time?
66.
66. But that is in the 1 year time. But if you want to pay that value today, what would have been the value?
You discount it.
So we discount it by what? 1.1. So that will be divided by the discount factor. It will be the discount factor, which is the future value over the what? Over 1 plus R exponent n. And it's only 1 year, so that will be 1.1. What are we getting?
60.
That will be 60. So we're supposed to pay 66 in a year time, but today's value is what? 60. It means that we are paying interest of what?
6 million.
Okay. So after getting this, then you count to the non-controlling interest. Gina, your hand is up.
Yes, sir. Please, how did you get the rate?
The rate is given in the question.
Okay, 10%. Thank you.
Okay. So you now come to group return earnings. So don't wait till I've even forgotten. I should have created a space for all of these ones. The group return earnings, it will be for the parent. We start with the parent own. So what is the parent group return earnings? What is the parent return earnings? Would that be 300? Okay. That will be the opening balance plus the profit for the year. Okay. All right. Can we put the net assets there small? Share capital. What will be the share capital of the subsidiary?
The share capital.
That will be 200.
200.
Okay. Return earnings is what?
At acquisition is 120.
120. At reporting will be what?
140.
That is very nice. So after doing this, then you leave it and move on to something that you come across again and bring it over here. So you'll be doing it what? You'll be doing all of these things what? Simultaneously. Any of them that you have seen, adjust it. Don't say you have to tackle it one by one. So let's come to this one. So we are done with this one. The return earnings, there will be a finance cost. Do you agree that the return earnings, there will be a finance cost of 6?
Yes, please.
Yes. The finance cost that we are paying on the what? On the deferred consideration. Do you agree that under the current liabilities, we'll be having a deferred consideration value of 66? Think about it. Sun has only recorded the issue of the loan note. That is the 120. The value of Gina, I will take your hand. The value of each Sun share at the date of acquisition was 75 Ghana's 75 pesos, and Sun has cost of capital of 10%. So the only thing that they have recognized is the what? The issue of the loan note, which is the 120 that we have gotten. But you can see that the investment over there is what? 121. What is bringing that particular one? We are going to find out soon. Gina, your hand was up.
Yes, sir. Please, I want to know how did they get the 140?
The what?
The return earnings report in the 140. How was it?
Look at the return earnings. Under the return earnings, what are the things that you can see there? You see 1st April, isn't it?
Yes, sir.
That is the beginning of the year, and profit for the year is what?
20.
So if at the beginning of the year you have 120, and during the year you made a profit of 20, what will be your total reserves?
Okay, 140.
You didn't mention the answer to me.
140.
Okay, thank you. All right. So they say that the Sun has only recorded the issue of the loan notes. The value of the Sun share at the date of acquisition was 75 pesos, and Sun has a cost of capital of 10%. So the only thing that they have recognized as the investment is the what? The issue of the loan note, which was 120. But the investment over there is 121. Where is the one coming from? We'll find out soon. We are going to find out soon. So let's count to Sun also incurred direct attributable cost of 2.4 million on acquisition of what? Moon. Okay. Sun also incurred directly attributable cost of 2.4 million on acquisition of Moon. This cost comprised 1.4 Auntie Abigail, what I'm saying I can hear you, so you don't have to repeat what I'm saying for me, or what I'm saying for me again, because I know what I'm saying. All right. So the 2.4, they have given you the breakdown of the 2.4. This cost comprised of what? 1.4 million, which is cost of issuing own shares, charged to operating expenses. 1 million due diligence cost included in the carrying value of the investment in Moon in Sun's own statement of financial position. So you can see that the increment in the investment over there, which is 1 million, is as a result of what? The due diligence cost. But the issue now is, how do we treat these two costs? How do we treat them? I have said something. I have even solved this particular question the time I was solving the statement of profit or loss, where I say something about what? The cost. I said that if the company incur a cost of issuing its own shares, how are we going to deal with it? How are we going to deal with it? If they incur a cost of issuing its own shares, how are we going to deal with it?
You said we capitalize.
I said we should capitalize, isn't it?
Yes, sir.
Someone is saying the expense. So can you see expense? Someone is saying the expense. I said we should capitalize. But any other cost apart from the what? The issue cost should be what?
Expense.
Expensed.
Okay. So in actual sense, the cost that should have been expensed should have been 1 million, isn't it? But they have expensed what? They have expensed 1.4. It means that they should have expensed 1 million, but they have expensed what? 1.4. It means that the expense cost has been what? Overstated. So what we do is that we now bring it to what? 1 million. Or another way of doing it is that if they say they have expensed the 1.4, it means that they have charged it against their profit or loss, which is going to affect their retained earnings. But the actual cost that should have been expensed should have been the due diligence what cost, which is 1 million. So instead of you expensing 1 million, you have expensed what? 1.4. It means that you have reduced your profit by what? 0.4. So what we do now is that we come and what? The overstatement of the due diligence cost, the due diligence cost of what? 0.4 should be added. We should expense 1 million, but we have expense what? 1.4. It means that we have what? Overcharge our expense, which is going to reduce our profit. So we go and add it back to have our profit to be what? The same figure. We should expense 1 million, not what? 1.4. That is the case. They have expensed 1.4 instead of 1 million. So what will now happen to the 1.4? The 1.4 should be capitalized. What does it mean to say the 1.4, the cost of issuing its own shares to be capitalized? What does it mean? If you are issuing shares to a public, how would the company classify this particular thing? Is it going to be an asset or investment? Is it going to be an asset or a liability rather, not investment? If a company is issuing shares to the public in accordance with financial instruments, how would this particular instrument be classified? Is it going to be a financial asset or a financial liability?
Also,
Financial liability.
Okay. Since it's going to be a financial liability, what you do is that the issue cost should be net against the what? The equity. So the 225 that you are receiving is like a liability. So if you are capitalizing it, it means that you are debiting your liability. So you subtract it from the equity. You have learned something today new. Okay. The issue cost should be treated in accordance with our financial instruments. So if the company is issuing its shares to the public, they are going to be owing the public. So that should be classified as a financial liability. And that will be having a credit balance. This is an expense. You are going to be crediting cash and debiting the expense, but we want to capitalize the expense, meaning that we are going to debit the liability account by reducing it. That is it. So this is all about the top there. So what we do is that we now remove all the investments because, yes, please. All right. So the investments, 120 for the loan note and 1 million for the due diligence cost, that should be expense. So all the investment will go. Let's now have time to take the footnotes one by one. All right.
Okay, so A, it says at the date of acquisition, the fair values of Moon's net assets were approximately equal to their carrying amount, with the exception of its properties. These properties have a fair value of 40 million in excess of their carrying amount, which would create additional depreciation of 2 million in the post-acquisition period to 31st March 2017. The fair values have not been reflected in Moon's statement of financial position.
Okay. So at the date of acquisition, the fair values of Moon net assets were approximately equal to their carrying value, with the exception of properties. These properties had a fair value of 40 million in excess of their carrying amount, which will create additional depreciation of 2 million in the post-acquisition period to 31st March 2017. What is the meaning of this? It means that the value of the asset has increased at the date of acquisition, isn't it? Are they saying that the value of the asset has increased? There was an excess amount of 40 million. Is that the case?
Yeah.
Yes, sir.
Okay. If asset is increasing, liability is constant, what will happen to the equity? Okay, let's come here.
Equity will increase.
Let's come here. I like demonstrating a lot. All right. Let's come here. Let's assume that the asset that the company has was 200. That is their total asset. And their liability was 80. They have subtracted liability and they are getting a net asset of 120. Now the question is saying that there is one asset which has now increased by what? 40. So now the value of the asset will now be 240, but the liability will still be 80. What will happen to our equity? Our equity will now be what? 160, isn't it? Is that the case?
Yes, sir.
All right. So if the asset is increasing, the assumption is that liability is still constant. So the equity will also be what? Increasing. So we count to our net assets. We count to our net assets. Then we have what? Properties. The value is 40 million, isn't it?
Yes, sir.
Okay. 40 million. At reporting, would it still be 40 million?
Yes, sir.
Are you sure?
Sir.
Yeah. At reporting will be what?
40.
No,
40,
please.
40 million.
It will be 30.
Actually,
It will be 38. Okay. But what you
Okay,
know,
you net off the
yeah. But what you
depreciation.
know is that you bring the 40 before you bring the depreciation, isn't it? We are all looking for a
Yes,
tick.
sir.
We are all looking for a tick. So bring the 40, then you bring the depreciation too at the reporting. That will still give you the 38. But because me, I'm using time, I know that that one tick will not do me anything. So I can just take the 40, and I know that at reporting, I'm going to use 2 million out of this particular asset. So the carrying value of the assets now will be what? Will be 38. But what you do is that you can bring the 40, then you bring the additional depreciation here. Depreciation should be charged against what? Profit, isn't it? And the profit is under what? Acquisition or reporting?
reporting.
Reporting. So the depreciation will come here, 2 million. So if you decided to what? To recognize the 40 million, the asset is depreciable asset. So it will create additional depreciation of what? 2 million. So you have to charge the depreciation too. If you go to statement of financial position, we can decide to add the 38, or we can decide to add 40 and remove what? 2 from it, isn't it? So it means that the 40, the question says that the fair values have not been reflected in most financial statements. It means that included in their assets, the 40 million, that is the increase, is not part of it. So we bring it to now increase the value of our assets. But then again, we have used 2 million out of that value. So the value will now be 38. Can we move on? All right. Let's look at the B. That is that part. We are done.
Okay, so the B, the intellectual property is a system of encryption designed for internet use. At the reporting date, Moon has been advised that government legislation passed since acquisition has now made this type of encryption illegal. Moon will receive 10 million in compensation from the government.
What are they saying here?
Impairment.
Impairment of the what? The intellectual property. Okay. The condition was there from the beginning, but it is at the reporting date that what? There's a need for us to test for what? The impairment. Are you okay? So
Yeah.
if we come here, the intellectual property, what are we going to do? We are going to reduce it by 20. There's an impairment of what? 20, because they are going to receive only what? 10 million from what? The government. Meanwhile, the intellectual property is 30. So you are receiving only 10 million. It means that you are losing what? 20 million. And this 20 million will be treated as what? This should have been subtracted from profits. But we haven't done that. So what we do now is we are going to have a okay. So we are going to have impairment loss. Where will it appear?
Reporting date.
At reporting. So this is at reporting. The question says that at reporting, although the legislation has been passed since acquisition, but at the date of acquisition, there is no indication that this particular legislation is going to make the intellectual property what? Useless. It is as reporting that we have noticed. So we we carry out an impairment test at reporting. So the question says that at the reporting date, Moon has been advised that a government legislation passed since acquisition has now made this type of encryption illegal. Moon will receive what? 20 what? Moon will receive 10 million from this. Okay, let's come to the C.
Okay, it says SANS policy is to value the non-controlling interest using its proportion of fair value of subsidiary at the identifiable net assets.
Some people's hands are up. I have two people. Okay, Gina and Zoom. Okay, Zoom, your hand is up.
Okay, so sir, with the intellectual property, I thought because the question says it's now illegal, the company will now recognize it from
The
their
intellectual,
records.
no, they are going to receive what 10 million compensation. So it will not be
Okay,
removed
so
entirely.
okay.
It
They
was
are
30
applying
million.
since acquisition.
It has
So
been
what does that
it has been
past
passed
since
since acquisition, but at acquisition date there is no indication of the impairment. It is at reporting date that they are now advising us that the legislation is going to make the what the intellectual property illegal. So the law has been there since acquisition. The condition has been there, but it is now that it is critical that the condition they are telling us that okay, now the intellectual property will be what illegal. The intellectual property was not illegal at the date of acquisition. No, it is at the reporting date that they have been advised that the law that has been passed since acquisition. The law has been passed since acquisition, but the law at acquisition date was not making the intellectual property illegal. It is at the reporting date that we now realize that okay, the impact of the law is going to make what the intellectual property illegal. So the impairment test will be conducted on the date that we have decided to what to undertake the impairment on the assets. So the day that we have the condition now that this is going to affect the asset, that is the day that we undertake or we conduct the impairment test on the assets. Though the question says since acquisition, what they are trying to tell you that the law has been there since acquisition, but it is at the reporting date that they have now realized that no, this law is going to make their intellectual property illegal. So therefore, they have to conduct impairment tests on the assets. All right.
So, sir,
Yes,
sir.
please. Yes, please.
So what about the net assets at acquisition of Moon? Won't it affect it?
No, at acquisition, the intellectual property is still useful. It is at reporting data they are now advising us.
At the second part, say at the reporting date, Moon has been advised that government legislation passed since acquisition.
So your problem is the since acquisition. Is that your problem?
Yes, please.
Okay. If that is your problem, then you don't have problem. Okay. Okay, so you are thinking that the impairment test should be conducted at the reporting at acquisition date, isn't it?
Yes, please.
Okay. If the law has been passed since acquisition, is there any indication that the law is going to affect the intellectual property? Oh, Abanga, people who are saying the yes, please. I'm also asking you a question. I also want to say yes. So answer my question. The law has been passed since acquisition at the acquisition date. Is there any indication telling you that the passing of the legislation is going to make the intellectual property illegal at the date of acquisition? Do you have any information on that? The law has been passed, all right, but the intellectual property is still what? Useful. It's still useful. But it is as the reporting date that they have now realized that no, the law that is passed since acquisition is now going to have effect on what? On the intellectual property. Please, did you subtract the 10 million from the 30 million to get 20? Yes, please. We have 30 million. They are going to give us a compensation of what? 10 million. It means that we are going to be losing what? 20 million. Okay, so you shouldn't be confused with the past since acquisition. They are just telling you that the law has been there. The law has been there. The law has been there. But doesn't mean that the date that the law has been passed was the date that the company is aware that the intellectual property is going to be useless. No, they have been advised at the reporting date. So though the law has been passed, but the intellectual property from that time was still useful. Was still useful. Okay, it's just like you have a software. You have an old software that you are not using. So the software that you are not using. So you have an old software, but you have now realized that okay, there's a new company that manufactures a software, but this software will be what? Will be published in 2 years' time. The software has been developed. The software has been developed, and the software will be published or will be effective in 2 years' time. Are you going to say that the impairment will start from today? Are you going to start conducting impairment tests on the software that you have today? That okay, a new software has been developed, so this particular software will be useless. No, it will become useless when that particular software has been launched. So the law has been there, but the law is not making the intellectual property illegal at the date of acquisition. It was a reporting that they have now been advised that the intellectual property will now be what? Illegal as a result of a law that has been passed since acquisition. Passed since acquisition doesn't mean that the law is making the intellectual property illegal at acquisition. And if you look at the A2, the question was very clear. At the date of acquisition, the fair values of most net assets were approximately equal to the carrying amount with the exception of 8 properties. It means that the fair value measurement is only related to the property. All right. So Banga and the rest, don't be confused with the, yeah, Nas. Yes, please.
Please, can you hear me?
Loud and clear.
The intellectual property. And also the intellectual property. So meaning as acquisition, it will be 30 days, right?
Yes, please. Yes, please. Is that?
And as reporting will be 20.
Our reporting will be 10, not 20.
10 rather.
As reporting, it will be 10.
I thought maybe you see the intellectual property.
The intellectual property is part of,
I'm saying that
it's already part of the asset. You cannot add as acquisition. It's already part of the asset there. So it means that it has been taken into consideration before calculating the net asset at acquisition. But the only thing that will happen is that instead of it being 30 at reporting, it is now 10. It means that the value has reduced by 20, which is impairment.
Okay, thank you.
I hope you are okay now.
Yes, please. I'm okay. Thank you.
All right, thank you. All right. Senior Emmanuel, can we move on?
Shall I continue?
Yes. So we are the C is the how the non-controlling interest will be calculated. So
Yes,
we are not there yet. Let's come to the D.
Okay, so to D, it says at the beginning of this year's second quarter, Sun obtained a 25% equity interest in Galaxy. In exchange for this investment, Sun transferred a parcel of land with a book value of 30 million Ghana cedis and a fair value of 36 as at acquisition. As at acquisition date to Galaxy's former shareholders, Sun has not yet recorded this transaction, but the associated professional charges of 0.5 million Ghana cedis have been included in SAN's operating expenses during the current year. Galaxy's reported annual profit after tax of 5.5 million Ghana cedis through its first quarter's interim accounts this year had shown a loss after tax 2.5 million Ghana cedis.
You see, the way you are reading the thing means that in the exam you don't even know what they are saying because you're not reading the thing in order. You see, sometimes the way you are reading the question will give you the understanding of what they are saying. They say at the beginning of this year's second quarter. So what is the second quarter? At the beginning of this year's second quarter. They are not talking. You can see that the reporting period is 31st March, isn't it?
Yes, sir.
So 2017. So don't say that they are talking about 2017 second quarter. If they are talking about 2017 second quarter, it means that the year has already ended. You can see at the beginning of of this year's second quarter, if you are taking the 2017 as the year, that will be 1st April, isn't it? All right, but they are not talking about this year as in a year. No, they are talking about the beginning of the accounting year. So the beginning of the accounting year will be 1st April 2016. So they are talking about at the beginning of this year's second quarter, this financial year's second quarter. That's what they are talking about. Not this year as in this year. So at the beginning of this year's second quarter, they are talking about financial year. So the financial year will start from what? 1st April, isn't it? The next quarter, the quarter will be from April to June. The beginning of the second quarter will be what?
1st July.
Will be
July
1st
to
July.
September.
Okay. The July, then the acquisition was done from July to where? July to 31st March,
31st March.
isn't it? All right. So let's look at how was the consideration settled. Let's look at investment in associates. So this will now send us to investment in associates. Investment in associates. Okay. This will now take us to investment in associates. So let's look at the initial value, which is the value at acquisition. What is the value? How much are we transferring the land to them?
36.
Okay. And how much was the carrying value of the land?
30.
Okay. They say that this SAN has not yet recorded this transaction. SAN has not yet recorded what? This transaction. It means that the 30 million of the land is still in their what?
Yeah, PP.
Their PP. They can also this one is a land, so there's no depreciation on this particular item. There can be a transfer or depreciable item where the SAN is still depreciating that particular asset. So you have to reverse everything. So if you come here, there will be a gain of what? What will be the gain?
6 million.
There will be a gain of this on 6 million, which will be taken to what? Return earnings. But if you come to this place, we are going to remove the 30 million from what? The PPE, because they are still carrying the land in their books as 30 million, which is the carrying value. But this has been transferred to what? To the former shareholders of what? Galaxy at 36, where they are making a gain of what? 6 million. But they are still having the land in their books at the carrying value, which is 30 million. So since they have now transferred this one, they don't have control over the land. The land is no longer their own. So they have to de-recognize the land from their books. So that is why we have to take the 30 million from the PPE. We have to take the 30 million from the PPE. Okay. We are done with that first part. Okay. And a fair value of 36 million as at acquisition date to Galaxy former shareholders. SAN has not recorded this transaction. So the investment in associate, we have done that already, 36. That is fine. Okay. Then let's now come to this one. SAN has not yet, but the associated professional charges of 0.5 million had been included in SAN's operating expenses. The professional charges are supposed to go to where? It should be expense, isn't it? So they have done this, they have expensed it already. That is fine. We don't have any problem with that. That is fine. The professional charges must be expensed. Must be what? Expensed. the professional charges must be expensed. Someone can also say that the professional charges should be net against the what? The land, but all professional charges associated with what? Investment in other assets or acquisition of shares in other company might be decided to be capitalized or might be decided to be expensed. But the ideal one is that it must be expensed. It must be what? Expensed. It must be expensed. Someone can decide to add it, but you can't add. It's not part of the amount that you are paying. Yeah, Zoom, your hand is up.
Okay, so sir, if they didn't account for the land, then it means that it was included in their net asset computation.
No,
So
no,
won't we?
this is not for, it is not the subsidiary that is calculating this one.
Okay, yeah.
This is the parent that is
Sorry.
buying. All right.
Okay.
All right. Thank you. Okay. During the current year, Galaxy reported annual profit after tax of what? 5.5 million. Though its first quarter interim account this year had shown a loss after tax of 2.5. So it means that the entire profit for the year was how much? The profit for the year was how much?
Should I say
8 million?
5.5.
5.5.
8 million.
5.5?
Okay, let's take this one. The profit for the year is 5.5. Okay. This is 12 months, isn't it? Okay.
Yes.
But at the beginning of the time that we acquired them, which is before the first quarter, we acquired them at the beginning of the second quarter, isn't it? All right. The profit that they have made for the full year is 5.5. But before we acquired them, they had a loss of what? 2.5. Are we okay with that?
Yes.
Okay. So it means that during the 9 months that we acquired them, they have made a profit of something that have reduced the what? Or that have eliminated the initial loss, isn't it?
Yes.
So what will be the profit made during the 9 months?
8.
That will be 8. That will be 8. So we have 2.5 for the first quarter. Then we have now made a profit of 8 million during the last 9 quarters. That is why if you subtract the 2.5 from the 8, we are getting 5.5. So the company will now have the share of their post-acquisition profit, which will now be what? 8 million, not 5.5. We acquired them for 9 months. And during that 9 months, they have made a profit of what? 8 million. The first quarter, they have a loss of 2.5. But for the full year, they are now having 5.5 million profit. It means that they have made a profit of 8 million that has canceled the 2.5 to now have what? The 5.5. So that will be 0.25 multiplied by what? 8 million. How much are we getting?
2.
That will give us 2. And this will go to what? Return earnings of what?
Return earnings of the parents.
So share of what? Associate profits. So that will give us 0.25 times 8. Okay, that will give us 2. Let's come. So we are done with that side. Okay. Let's come to the E.
Okay, so to the E, it says at year end, Galaxy's inventory included items worth 1.2 million Ghana cedis bought from Moon. These items had cost Moon 0.8 million Ghana cedis.
Okay. So what are they saying? This is a transaction between what?
The subsidiary and the associate.
So how do you account for this? The one that you know is between the parent and then the subsidiary and the parent and then the associate, isn't it? Okay. You see, if the transaction is between the subsidiary and then the associate or the associate and then the subsidiary, it is still accounted for the way we account it for the subsidiary and then the associate, or the subsidiary and then the parent and then the parent and then the associate. All right. So this will just be, you just take the Moon as the parent. So it will just be like the parent is trading through Moon with the subsidiary, with the associate rather. So what will happen is that at year end, Galaxy's inventory include items of what? Items worth 1.2 million bought for what? Moon. these items had cost Moon 0.8 million. What is the unrealized profit on this particular item?
0.4.
0.4. So who is going to suffer the unrealized profit?
Moon.
So that will count to the net asset table, isn't it?
Yes,
So we
please.
have 0.4. But what will happen is that we assume that this is happening between the parent and then the associate. If that happens, the parent is going to suffer the unrealized profit, and this will also be subtracted from the investments in associates, the parent investment in associates. So we have the provision for unrealized profits, that will still be 0.4. So that is the entry. That is the entry.
Hello,
So
sir.
yes, please.
Mr. Linus,
Yes, please.
With the unrealized profit, when you calculate
please, are we not
the parent percentage
charging
on it?
the
Which yeah, you should take it one by one. With the unrealized what?
I said the 0.4. I thought that we will calculate the parent's share in the associate on it to get the parent portion.
Sorry, it's supposed to be the
associate?
It's supposed to be the this thing. The parents will just take their own share of that one. Sorry. Okay. It means that people they know the thing power. Okay. So this will be 0.25 times 0.
People have learned. Oh.
So this will also be 0.25. The parents will have their own share of this one. That is very nice. That is very nice. The associate is not part of the group, so let's come here. So what are we having?
0.1.
Minus.
Yes, please. 0.1.
What?
Yeah, I can hear you.
Oh, finish. I know, but finish with the calculation first.
Okay, I'm done. But I'm not done
It's
yet.
nothing, yeah.
Okay.
Yeah. I'm just pleading that maybe after this class, you post the video early, because some of us, our network have disturbed us. But
If your network can disturb you, why will you even bother to do CA? CA is for people who have stable network.
I can't hear you.
Oh, don't worry. I'm saying that I will do it for you. It's your personal property, so you can have it.
Please go back to the previous slide.
Which one? This one?
Yes. Where you have the P2P. What would the payment loss go to?
The impairment will go to reporting.
So is it for the next asset list? Are you considering the next asset list?
Yeah. This is a continuation of the net assets. Okay. So
Hello, sir.
Yes, please. You said you didn't get what?
The provision for unrealized profit.
The provision for unrealized profits. What will happen is that the associate is not part of the group. So the parent will only have its portion of the unrealized profit. So the unrealized profit is 0.4, but the parent is having only 25% in the associate. So they will have only 25% of that one. That is all.
Sir.
Yes, please.
Please, with the unrealized profits, I thought that since it's only the parent that has interest in the associate, we will send the unrealized profit to the group retained earnings, because
it's
when
not
we
a
send it to the net asset,
it's not a parent that is selling. It is a subsidiary that is selling, so the subsidiary has to suffer for.
But the unrealized profit is as a result of the parent interest in the associate.
But the parent is not the
So
one
if we
selling
send it to
direct.
them,
The parent is not the one selling directly to. So the umbrellas profit is borne by the
okay,
person selling.
okay, sir.
Okay.
Thank you, sir.
Okay.
Linus.
Yes, please. Yeah. Senior, the person who just it was it Nas? Nas, were you the one?
Yes. No.
No, the
Is
first
it
person.
me?
Yeah.
The first
If the profit that will be coming from is the subsidiary is selling to the associate, isn't it?
Yes.
Okay. So if the subsidiary should sell to the associate and they are going to have the full profits, is it the parent who is going to enjoy all the profits?
No.
So it means that the loss should not be borne by only the parents. Are you okay?
Okay, sir.
Yeah. All right. Thank you.
Thank you.
Yes, Auntie, you cannot talk.
Okay. Mr. Linus, please, sorry to take you back.
Don't be adding the mistake to my name. You are going to complicate everything. Just call me
Okay.
like.
Okay, Brain.
Yes. Auntie, I can hear you. Oh, is she gone? Auntie Gina, your hand is up.
Her network.
Yeah, Linus. I know.
Hello, Mr. Linus.
Okay. Yeah, I can hear you now.
I said that I saw some 0.4 in the group return earnings. That is overstatement. And I want to know whether the overstatement is a difference between the cost of issuing shares and due diligence cost.
Exactly.
Overstatement due.
Yeah, they're supposed to expense 1 million, but they have spent 1.4. So the 0.4 should be added back. Or another way of doing it is that you add the 1.4 back, then you subtract the 1 million. You should expense 1 million, not 1.4. So add the 1.4 back, then you subtract 1 million. That is also another way of going about it.
Okay, thank you.
All right, Auntie
Thank
Gina.
you.
Auntie Gina, you want to talk? Oh, you're okay.
No, I'm not okay. So I'll just ask them. Sorry to send you back. I'll just ask them the date of acquisition for the associate. Will it be on the 1st of August?
No, it will be 1st July.
Okay.
At the beginning of this year's second quarter, the reporting date of the associates or the parents is 31st March. So the year will start from 1st April. 1st April to June is the first quarter.
Yes.
From April to June is the first quarter. So at the beginning of this year's second quarter, so second quarter will start from 1st July.
Okay.
It will be July to September, so it will start from July. Are we okay? So let's put our net asset together and move on. So 200 plus 120 plus 40. What are we getting?
360.
360. Okay. At reporting is what?
357.9.
357.9. Are they making profit or loss?
Loss.
Okay, loss of what? 357.
2.1.
2.1. Okay, 360
Yes, sir.
minus 357.9. So that will give us 2.1, isn't it? This loss will be
Yes,
shared
sir.
among the NCI. So let's calculate the NCI figure now. They say the NCI is proportionate. So fair value of the NCI will be 0. What will be the NCI value? We didn't even find the percentage holding.
25%.
Would that be 25%?
Yes, sir.
Are you sure?
Yes, sir.
The parent one is what?
75.
How did you get a 75?
I divided the subsidiaries equity share by their share price to get a total number of share, which was 8 million. So
Which was 800 million, not 8 million.
800 million.
Okay. So
Then
you
I
have
calculated the
you
percentage
have
on it.
done 200 over 0.25, isn't it?
Yes, sir.
Okay. So the total number of shares is 800 million. Okay. And the NCA will be having 200 million. So 200 divided by 8. Okay. So 0.25 times what? 360, isn't it?
Yes, sir.
All right. So what are we getting?
90.
90. So they are going to have their share of what? The loss. Share of loss. That will be 0.25 times 2.1. Is that correct?
Yes, sir.
So what are they going to have?
0.525.
0.525. Okay. 0.75 times 2.1. So this will be a deduction. Let's come to the parent one. The parent one will be what?
1.575.
1.575. Okay. So that will be a loss. Can we put the figures together? 90 minus 0.525. I'm having 89.475. Let's put the 300 minus 6 plus 0.4 plus 6 plus 2 minus 1.575. I'm getting 308.25. 308.25. Is that correct?
Yes, sir. 308.
Okay.
300.825.
Can we calculate the goodwill now?
Yes, sir.
So what will be the total purchase consideration?
$405.
405. Okay, what will be the parent share of the net assets? That will be 75% times what? 360. I'm getting 270. Is that 270 correct?
Yes.
Okay. So what will be the goodwill from your side?
One three five.
Okay. Let's come to the investment in associates. What will be the investment in associates?
That is 7.9.
30.
37.9.
Okay. 37.9. Okay. So 37.9. Let's put the PP together.
Nine is
97. Okay. Current asset, would that be 230?
Yes,
plus 225.
230.
Okay, so
230.
all right. So this will be 523.6. What is the return earnings? It was 300,825. Our non-controlling interest was what?
89.475.
89.475. Our loan will be what? 140. Okay. Our current liabilities will be what? 200 plus.
346.
Okay. 346. So try to put all of them together. I'm having 1399.9.
Yes, sir.
Okay.
Sir, please, can you go back to your workings for investment for associate investment now?
Okay, I'll go there, don't worry. Let's kill the last one. Then I will talk about ratios, that is all. Emmanuel, are you still there?
Yeah, boss, I'm here.
All my readers,
Okay.
all my readers there, they have to understand. I hope you're on top of issues.
Small there.
It is well.
Sure. Okay, so with the last one, F, it says year-end reviews of assets for impairment revealed no losses.
I've even looked at that one before doing everything. So let's come to the question 3.
Okay, so question 3. It says on 1st September 2019, Black Limited purchased 19.2 million ordinary shares and 15 million preference shares in White Limited for 116 million Ghana cedis and 30 million respectively. Below are the financial statements of the two entities. So statement of financial position as at 30th November 2020. Required. This is prepare consolidated statement of financial position for Black Limited Group as at 30th November 2020.
So consolidated statement of financial position as at 30th November.
This 30th November 2020.
2020. So you see the way you can see the way I arranged the way they arrange the financial statement. You two arrange it like that. So you can see that they have brought equity first. So you can also decide to bring the equity. So the equity, we have the ordinary shares. Ordinary shares, we bring only the parent own. So what is the parent figure?
300,000.
Okay. The parent figure. Okay. The next one is what? Preference shares
Preferences.
is how much?
80,000 plus 60,000.
Plus 60,000. Okay. Other components of what? Other components of equity is what?
11,000.
Okay. Return earnings. Return earnings mostly you do workings for it, so leave it. Okay, then you come to non-controlling interest. Then after this one, we move on to what?
Non-current liability.
Non-current liabilities. Okay. 5% what?
Loan notes.
Okay. The figure is 63 plus what?
30,000.
Okay. So we have current liabilities, isn't it? Then the current liabilities, we have current accounts. Current account, what do we have there? White Limited. What is the meaning of that? The current account, White Limited, what is the meaning of that? Other current liabilities. The other current liabilities is what? The current account is 15,000. Other current liability is 124,582,000. Okay. The current account is under who? Is under which company?
White Limited.
No. It's Dash White
The
Limited.
parent, Black.
Black.
So it means that Black is saying that they are owing White Limited how much?
15,000.
15,000. Okay. That is the meaning. Let's count to the total equity. So the next one that we have now, we have non-current assets. So we count to non-current what? Non-current assets. The first one will be PPE, isn't it? Let's pick the PPE figures. We have 404,000 plus 205,000. The next one is what?
Intangible assets.
So intangibles. These intangibles are excluding goodwill. So if you like, you can add a goodwill to them, or you can show the goodwill as a line item. All right. So let's come here. What is the next one? Trade investment. You can decide to bid the investment, then you reconcile it. Okay. So we have the trade investment there. Trade investment. The trade investment is how much? Trade investment is what? 91,500
91,500
plus 31.
31,000.
Okay. So you can bring the investment in what? In white, but at the end of the day, you reconcile it. So you can decide to leave it. You can decide to leave it. We don't know whether we have an associate, so you can leave a space, then you move on to there. You can bring goodwill. If it is not a goodwill, you can just put dash there. Then you can leave a space and go to current assets. The current asset, what do we have? We have current account, isn't it?
Yes.
The current account is under who?
White Limited.
So it means that the Black Limited is saying that they are going to receive what? 18,000 from what?
White Limited.
Okay. So that will be 18,000. You can see there is a difference there, isn't it?
Between the 15 and the 18.
Okay. So that difference might be a settlement. One person might be, there can be a cash in transit or goods in transit. So other current will be 156,000 plus 84,000. Okay. Let's take the footnote now. So let's go to the workings. The workings will always be the workings. The first one will always be the group structure. Put it there. Okay. For me, I don't have time for the group structure. So me, I'll start with the important ones. Net assets. So at acquisition, at reporting. Okay. All right. So let's start with what? Ordinary shares. So the first one will be the ordinary shares. How much is the ordinary shares for the White Limited? We are doing this for the subsidiary, which is the White Limited.
120,000.
120,000. That will be the same as what reporting. All right. Let's come to return earnings. They don't have any other component of equity. So let's take the additional information one.
Acquisition, the balance on White Limited's retained earnings and other components of equity were 62 million and 2.5 million respectively.
Okay. So return earnings was what? Return earnings will be what? 62,000.
62,000.
Reporting is how much?
91,000.
Okay. Other component of equity was what?
2,500.
But this will be dash, isn't it?
Yes.
Okay. Let's come to the B.
The fair value exercise conducted on White Limited at acquisition disclosed that some inventories had their book value falling below their fair value by 4 million. Equity percent of these inventories have been sold by the year end.
Okay. So what is the meaning of this? Has some inventories had their book value falling below their what? Their fair value by what? 4 million. It means that the fair value is more than the book value by what?
4 million.
4 million. So we come here, we have inventory. At acquisition, it will be 4,000, isn't it?
Yes.
At reporting, they are saying that 80% of these goods has been sold, isn't it?
Yes, sir.
So what will be the figure at reporting? What will be the remaining portion of this 4,000?
800.
It's 800. Okay. So if you go to inventory, what are we going to do to the inventory? We add 800.
At the 800.
Okay. The inventory has increased, but they haven't taken that one into consideration. So we are going to what? We are going to, it was 4,000, but we have sold what? 80% of it. So the remaining inventory will be 800. So you go and add it to the inventory. Okay. C, let's look at the C.
At acquisition, two restructuring plans relating to White Limited were considered. One, the first plan related to reorganization of one of its major plants. As at acquisition date, the agreed plan was yet to be communicated to relevant employees, but immediately meeting was held with all affected workers. Then the reorganization followed and was completed within 2 months. Closure costs amounting to 2 million were duly provided for. Final settlement has been made, but White Limited has not yet recorded the payment.
What standard is this?
IAS 37.
What does the IAS 37 says about restructuring?
Yeah, there must be detailed plan that the entity is committed to, and also the plan must be communicated to the affect to the parties that will be affected by the restructuring.
Okay. So this one, as at the date of acquisition, has the plan been communicated to those affected? As at the date of acquisition, has the plan been communicated to those that are affected?
No, sir.
No, sir.
So it means that at acquisition date, we're supposed not to make a provision, isn't it? So
Yes,
no
sir.
obligation is what is existing at the date of acquisition. So no provision will be made. But what are they saying? They are saying that, but immediately meeting was held. This meeting will be held afterwards acquisition. Okay, then the reorganization followed and was completed within 2 months. Closure costs amounting to 2 million were duly provided for. It means that they have done the provision for the cost after the meeting has been held. Then they made a provision for the 2 million. Okay, were duly provided for. Final settlement has been made, but White Limited has not yet what recorded the payments. So if a provision is made, where are we going to see the provision? Where would the provision be?
Current liabilities.
Liability.
It will be under current liabilities, but these have been settled. So how much was it?
2 million.
It was 2 million. So we are going to take 2,000 from this one, and we are going to pay this using our what? Our cash. We are going to pay this one through cash or bank. So liabilities, we have paid it, it will go. Then our cash will also reduce. That is it. There was no obligation at the date of acquisition, so we can't make a provision for liability. There cannot be a liability at acquisition. But after the acquisition, they have now had meeting with those that are affected, and they implemented a reorganization and they made a provision from that date, which is 2 million. This has been paid, but has not been what? Taken into consideration. So we are just going to do the what? The payments. The provision has been made, which is included in what? Current what? Liabilities. So if you are settling it, your liability will reduce and your cash or bank will also reduce. Let's come to the second plan.
The second plan involved the closure of a unit. White Limited had discussed the agreed plan with various stakeholders. The closure costs were estimated at 3.5 million, including relocation cost of 1 million. As at acquisition, the closure was duly effected 3 months after White Limited acquisition. White Limited has correctly recorded a final settlement.
So it means that at the date of acquisition, we have to make provision for this particular one, isn't it? The second plan involved a closure of units. White Limited has discussed the agreed plan with various stakeholders. It means that they are committed to a detailed plan, and the plan has been what? Committed with what? Or has been communicated to those who will be affected. They say they discuss the agreed plan with what? Various stakeholders. So the employees are also part of the stakeholders. The closure costs were estimated at 3.5 million, including relocation costs of 1 million as at acquisition. So it means that we have committed, we have communicated the plan to the people, we are committed to the plan. We are sure that the restructuring will be undertaken. So we have a provision as at the date of acquisition. So as at the date of acquisition, there is an existing what? Obligation in form of what? Provision. So you go to your net assets, then you now have what? The provision. We now have a provision. That will give us how much? How much will be the provision?
2,500.
2.5.
It will be what? I want to hear the figure. What?
2,500.
2 or 3?
2.
Okay. Relocation cost is just a cost like what? A transfer. Cost of transferring your staff. Okay. Are they still having this obligation? Is the obligation still existing at the end of the year? Is this particular obligation, is the provision still existing at the end of the year?
It was settled.
So the reporting will be dash, isn't it? Because we are not having the provision again. It was settled. So there will not be any balance on the provision. There will not be any liability at reporting. So that will be dash for that particular one. Okay. We are done with that side too. Let's come to the D.
White Limited's intangible assets represent a deferred development expenditure. At acquisition, it was established that the related project was no longer expected to produce future inflows, and hence the capitalized expenditure should be fully written off. Cumulative charges relating to this intangible asset since White Limited acquisition have amounted to 5 million Ghana cedis.
Okay. They are saying that at the date of acquisition, it was established that related project was no longer expected to produce future cash flows, and hence the capitalized expenditure should be fully written off. So you can see that this was detected. This particular impairment was detected at the date of acquisition. Okay, let's look at the intangibles. Let's look at the intangibles in the books. The intangibles, how much are they having there?
45,000.
45,000.
Okay, let me put calculation of goodwill here. Calculation of goodwill. What is the purchase consideration? Let's do it. Let's do it so that we. What is the purchase consideration paid? How much do we pay? On 1st September, this Black Limited purchased 9 point this one and 15 million. So the preference shares is 116, isn't it?
Yeah.
So 116,000. The ordinary shares is 116. Preference shares does not give ownership. So we are coming to look for the treatment of that one. Let's come to the NCI. Let's come to the NCI. Are we giving any information on the NCI? No, we leave it like that. Let's come to the group return earners. The group return earners. We can get some information on the group return earners. So we pick the parent figure. What is the parent return earners?
204,000.
Okay. Okay. Then let's be moving on small in a bit. Okay. So the intangible assets is a deferred development expenditure. But at acquisition, this is no longer to generate a future cash flow. But what is the value of the intangibles in the statement of financial position?
45,000.
That is at reporting, isn't it?
Yes.
Okay. The question is saying that the cumulative charges relating to this intangible asset since White Limited acquisition have amounted to what? 5 million. So it means that the original value of the intangible at acquisition was supposed to be how much?
50,000.
Supposed to be
50,000.
supposed to be 50,000. Someone is saying 40. Which of them are we going to take? The value at acquisition. The value at acquisition that they have subtracted 5 million from the value at acquisition, and they have now gotten what? 45 million. Do we agree with that?
Yes.
Okay. The question says that the cumulative charges relating to this intangible asset since White Limited acquisition have amounted to what? 5 million. So it means that from the date of acquisition to this one, the charges that we have taken to profit or loss is 5 million. So if we have taken the charges of 5 million to profit or loss and we still have 45 million, it means that the value at acquisition is supposed to be 45 plus the 5 that we have taken off is supposed to be 50 million. So you count to this one, you have your intangibles. You have your intangibles to be what? This will be written off. We have 50 million. Then at reporting will be what? 45. Is that correct? At acquisition will be 50 million, but the reporting is 45. So we write all the 45 off. All right. Is someone talking to me?
Yeah, I'm asking why we are doing that.
Why it's an asset that we are writing it off.
Mm.
All right.
Yeah.
Let's come to E.
Reconciliation between the two current accounts revealed that there was a delayed receipt of one invoice issued on 29th November by White Limited for some goods dispatched to Black Limited. White Limited transferred the goods at a margin of 331 over 3%.
Okay. So there's the reconciliation between the two current accounts. Let's do the reconciliation now. What is the difference between them?
3,000.
The difference is 3,000.
Okay. Where is the 3,000 coming from? Which one is higher? Is it the asset that is higher or the liability?
Asset. The
Okay.
asset is high.
So White is saying that Black is owing them how much? 18,000. Black is saying that they are owing White how much? 15,000, isn't it? Okay. They say the reconciliation between the two current accounts revealed that there was a delayed receipt of one invoice issued on 29th November by White Limited for some goods dispatched to Black Limited. White Limited transferred these goods at a margin of what? 33 whole number 1 over 3%. Is that the case?
Okay.
Yeah.
It means that Black is here to receive their goods, isn't it? Black is here to receive their goods, isn't it?
Yes.
Okay. So the first thing that you have to do is that you first have to assume that the goods has been received. So if the goods has been received by Black, this is what Black will do. If the goods has been received by Black, Black will recognize 3,000 that they are owing what? White, isn't it?
Yes.
Okay. Black, if the goods has been received by Black, the goods will be received on credit. And they are going to be having a liability of 3,000, and their inventory will increase by what? $3,000. Is that the
3,000.
case? All right. So this is how it's supposed to be. So you can see that the two current accounts will now be the same, isn't it?
Yes.
Yes.
Okay. If it is not the same, we can't be owing one another, so we cancel it. We write the current account off. So this will be minus 18,000. But the question now is the goods that White has dispatched to what? To Black. They have recognized the profit on the goods, isn't it? They have recognized the profit on the goods because in their separate financial statement, they are going to recognize the goods as a selling price of 3,000 that they have sold it. But in actual sense, none of the goods has been sold. So the profit element on the goods will be what? Unrealized. So what we do is that the goods are yet to be sold. So there will be an unrealized profit on the what? On the goods. So we have to calculate for the unrealized profit on the goods. We have to calculate for the unrealized profit on the goods. So provision for unrealized profits will be what? We are having 33 over 33 whole number 1 over 3. That is the margin. So what will be the markup?
Mm. 100 over 33%.
100 over what?
33%.
That is the fraction of the
The markup will be 1 over 2.
markup will be 1 over 2, isn't it?
Yes.
All right. The best way to determine the markup is first to change the what? The 33 whole number 1 over 3 to what? A proper fraction. So if you change it to proper fraction, that will be the same as 100 over 3, isn't it?
Okay.
That will be 100 over 3%, isn't it? 33 whole number 1 over 3 is the same as 100 over 3%. So this is the same as 100 divided by 3 divided by 100 because the percentage is divided by 100. This is the same as 100 divided by 3 times 1 over 100. So you are going to have 100 over 300, which is the same as 1 over 3. So you subtract the numerator from the denominator, you have 1/2. Okay. So the markup, this one they have given us margin, isn't it? It's margin straightforward.
Yes,
So,
margins, no margin.
yeah, it's margin straightforward. So we don't have to calculate this one. So this will be 1/3 times the 3,000. The goods are at selling price already. So the goods are transferred at selling price already. So the provision for unrealized profit will be what? Will be 1,000. And who is selling the goods? Is it the parent or the subsidiary?
The subsidiary.
So we come to the subsidiary, we have provision for unrealized profits. That will be 1,000 as reporting. If we go to statement of financial position, we are going to reduce our inventory by 1,000. All right. Let's take the this thing. Let's take the next one, the F. Emmanuel, are you there?
Yeah, hello.
Yes, yes,
Yeah.
I'm here.
Okay.
Okay,
F.
so with the E, or where with F,
Yeah.
it says Black Limited acquired 25% equity interest in Yellow Limited on 1st June 2020. Black Limited settled the consideration by issuing 7 million of its own shares to the previous shareholders of Yellow Limited. The share prices of Black Limited and Yellow Limited are at 1st June 2020 were estimated at 2.5 Ghana cedis and 3 Ghana cedis respectively. Black Limited has not yet recorded the above transaction. And it says Yellow Limited reported a net loss after tax of 1.8 million Ghana cedis for the year ended 30th November 2020. Yellow Limited's half-year interim report for the period ending 31st May 2020, however, showed a net profit after tax of 0.2 million Ghana cedis.
Okay. So when was this particular company acquired? When was the shares acquired?
1st June 2020.
So to the reporting date, how many months is that?
6 months.
Are you sure it's 6 months? We are preparing it for 30th. Okay,
Mhm.
that is 6 months. Okay, that is 6 months. So let's look at the fair value. What are we giving? What are we using to purchase? We are using 7 million shares, isn't it? We are giving them shares. So 7 million shares, we are giving them 7 million shares. Okay. And these 7 million shares will be valued at which amount?
2.5.
2.5. It will be valued at the parent what? Share price, because it's the parent that is giving the shares out. So what will be the value? Would it be 15,000?
19,500.
It will be 19,000.
17,500.
Okay. So we debit the investments in associates and credit what?
Equity shares of Black.
The equity shares of the parent. The equity shares are going to increase. So we come and put 17,500 here. It means that we are issuing additional shares. Okay. Let's come to what they are saying there. Okay. Yellow Limited reported a net loss after tax of what?
1.8 million.
Reported after tax, reported a net loss after tax of 1.8 million for the year ended 30th November. Yellow Limited have interim report for the period ending 31st May, however, show a net profit after tax of what? 0.2. So it means that before we acquired them, they have a net profit of what? 0.2, isn't it?
Yes.
And from that time to the end of the year, they are now showing a net loss of 1.8. So what happened during the last 6 months?
There's a loss of 2 million.
They made a loss of 2 million. So during the last 6 months, they made a loss of what? 2 million. Because we have done 6 months before you acquire us. That 6 months, we made a profit of 0.2. But after you have acquired us, we now have a net loss of what? 1.2 for the 1.8 for the whole year. It means that during the last 6 months, we made a loss of 2 million, which cancel the first 6 month profit of 0.2 to now have 1.8. So the profit for the year, the associate profit for the year or loss for the year is this one: share of loss, share of associate loss, share of associate loss will be, what is our percentage holding?
25%.
So 0.25 multiplied by 2,000, which is a loss. So what are we having?
500.
Okay, this 500 loss will go to where? The parent will take each share to what? The group return earnings. So share of associate loss. And that will be 500. Okay. Can we move on?
Yes.
Yes.
Okay. G.
Okay, Jane, it says included in the inventories of Yellow Limited are 1.2 million worth of goods bought from Black Limited. The goods had cost Black Limited 0.4 million more than the transfer price. These inventories were in good condition and highly marketable at the date of sale.
Okay. So they are saying that currently the goods has been transferred to what? To Yellow Limited at how much?
$1.2.
1.2, isn't it?
Yes.
Okay. The goods has been included in the inventories of Yellow Limited are 1.2 million worth of goods bought from what? Black Limited. These goods has cost Black Limited 0.4 million more than the transfer price. These goods has cost had cost Black Limited 0.4 million more than the transfer price. It means that the actual price of the goods should have been what?
1.6.
1.6, isn't it?
Yes.
But the goods were sold at a loss of what?
1.2 million. 0.4 million.
The goods were sold at a loss of 0.4. But the question is saying that the goods are still in what?
In a highly marketable, good condition and highly marketable at the date of sale.
Okay. The goods are in a highly marketable what? Condition. Okay.
Yes.
So it means that the goods has, if you are selling the goods at a loss, it means that the goods has impaired, isn't it?
Yes.
If you are selling the goods at a loss, it means that the goods has been impaired. But they are now saying that nothing is showing that the goods has been impaired. That nothing is showing that the goods has been impaired. So it means that the company, the parent has recognized a loss of what? 4 million relating to this particular goods. But since the goods are in a marketable condition, they should be valued at a cost. They should be valued at a cost. There is no indication of what? The goods being what? Obsolete. We only recognize the goods at net realizable value or the lower of any of the two when there is what? There is an indication of what? Obsolescence. So the goods has been sold at a loss of 400. This loss was written against the return earnings of the parents. And their inventory was also written down by what? The 1,600 instead of 1,200. So the assumption now is that the goods that were sold to the associate were worth what? 1,200, not 1,600. So what we do is that we now reverse the loss. We reverse the loss since the goods are still in a perfect condition. We now reverse the loss. So the goods were 1,600. but we sold what? 1,200 to what? To the associate. It means that there will be 400 goods left in the stock. So what we do is you count to the what? The retained earnings of the parents, then you reverse the loss. So reversal of the loss on the inventory, reversal of loss on inventory, and that will be 400. If you go to the inventory, you add a 400. So you come to this place and add 400. Since the goods are still in a marketable condition, it means that they shouldn't be sold at a loss. So the goods were 1,600, but we sold 1,200 out of it. It means that it should be left with 400. But we have taken the 400 as a loss from retained earnings. We have taken the 400 also from inventory. You have to bring it back. That is the idea about that particular one. You can only sold goods, or you can only sell goods below their market value or below their cost when there is an indication of what? Impairment, or there is an indication of obsolescence. So you have to reverse a loss of 400. You have to reverse the loss of the 400. So that is about that one. That is about that.
All right. Okay. So 8. It says at year end, no impairment was required on goodwill in White Limited. However, due to reported losses, investment in Yellow Limited was attributed with impairment loss of 0.25 million Ghana cedis.
Okay. So what they are saying is that the investment in associate has been what? Impaired. So we come to loss, impairment loss. So the associate, the impairment loss is what? 0.25. That will give us how much? If you multiply by 0.25 multiplied by 1,000, would that give us 250?
250.
Okay, this 250 will be sent to what? The retained earnings of the parents. So that will also be 250. Okay, do you have any other information about this?
No, that's all.
Okay, so let's put our net asset together. Reporting and at reporting and acquisition. Let's move on.
At reporting. 128,000.
128,000.
That's acquisition. 128,000.
128,000. Okay, 128,000.
Reporting. 164,200.
164.
200.
200.
Okay, 164,200. Okay, what is the post-acquisition profit?
36,200.
36,000.
200.
Okay. So 128,000. This one. So this will be shared among the what? The parent and the NCI. In what proportion?
Yes.
In what proportion?
25.
80 and 20.
So the parents will have share of post-acquisition profit. 0.8 times what? 36,200. Okay.
Yes.
The fair value of the NCI. The fair value of the NCI will be what? Will be 0.2 times what? 128,000. They are using proportionate method. So what are we going to get?
25,600.
25,600. Then we have share of what? Post-acquisition profits. That will be 0.2 times 36,200. What are we getting?
7,240.
240.
Yes,
Okay.
please.
The parent own will be how much?
The parent own will be 28960.
960. Okay.
Yes.
There was no impairment relating to this one. Let's add the NCF figure, the parent figure, then we move on.
Yeah, 32,840.
32,840. Okay.
The group routine in 23. 2610.
23,
2610.
2610. Let's come to investment in associates. Okay. Let's go to which one? Let's calculate goodwill. Goodwill, what we do is that we bring the parent net asset. That will be 0.8 times 128,000. What are we getting?
1
10. No, 10.
Okay, 1.
102400.
102,400. Okay. What are we having?
Yes.
13,600.
13600.
Okay. So our goodwill will be 13,600. This will be dash. The intangibles will also be dash, isn't it?
Yes.
Okay. Let's count to this one. Let's count to the top. The preference shares there. What will be the effect of the preference shares?
We will subtract the 30,000 that they paid for the preference shares.
Okay. Because we have that is not going to, it will be treated as part of what? Payment of the preference shares. So we are going to subtract the 30,000 there. Okay. Let's count to other components of equity. There is nothing with that. We are done with that. The non-controlling interest, what is their figure? So if you have done workings, you can put workings 5, workings 2. Like you have to indicate the workings. This will be 317,500. So this will be 110,000. The return earnings, what figure did we get?
232,610.
So 232,610. The NCR was what? 32,840. Okay. Let's count to the loan notes. Would that be 93,000?
Yes, please.
Yes.
90,000.
Let's count to the current account. That will be dash. We have cancelled it. Let's count to other current liabilities.
204,500.
204,500.
Let's count to the PPE.
609,000.
609,000. Okay. Let's count to trade investments.
122,500.
122,500. Current account will be dash. Okay. Current asset. Other current asset will be what?
239,600.
239,600. Okay, let's put them together.
Total equity. Total equity is 703,950.
Are you sure?
Total
Okay.
equity, only equity.
Only equity. Okay. Then I don't have space to write it. So you can just put all of them together.
Okay, equity and liability.
Okay.
Mr. Linus,
Yes, please.
did we add the investment in associates?
The investment in associate, we didn't add. Let me check. Okay, there is no investment in associate here. Investment in associate is how much? 17.
16750.
16750.
Okay. So what are we getting if you add all of them?
Okay.
1001450.
1001450. 1001450.
Yes, confirm.
Okay. Who is watching the GTV? The TV3. All right. This is all about the console. You have to be very careful. It might happen that you go to the exam, you see a similar question. So you have to be very careful. All right. Let me talk about ratio analysis, then we close. All right.
Okay.
So question 4 will be on interpretation of financial statements. The interpretation of financial statements will always be, they can ask you to use ratio analysis. They can also ask you to do common size analysis, and the common size analysis can be horizontal or vertical. The vertical is the one that you do in public sector. You can see that in the vertical, what you do is that you pick revenue as 100%, then you try to express what other items as a percentage of the revenue. That is the vertical one that we do. If you come to the statement of financial position, we use the total assets as a whole figure, which is 100%, and try to find the other items as a percentage of the total assets. That is the vertical one. Horizontal, what we do is that we find a change in the value. So year 1, year 2, year 3, the revenue was 20, 25, 30. What was the change over the year? That is the horizontal. Gina, your hand was up.
Sir, can you repeat the horizontal vertical? My network was.
Okay, if you listen to the recording, you will hear. The horizontal is we find a change. We find a change. So revenue was 20. The revenue has moved to 25. So what is the change in the revenue? What is the growth in the revenue? That is the horizontal. So the growth will be 5 over 20 times 100. That is how we do the vertical. That is how we do the horizontal common size. We do it on horizontal. Just get the meaning. Horizontal. We do it. We find growth. We find growth. The vertical, we do it. We pick one particular item and we express what? The other item as a percentage of that one. Mostly profit or loss, we use revenue. Statement of financial position, we use total assets. And that is what you do in the public sector. In the public sector accounting, you do the common size, you do vertical. All right. The ratio analysis. The ratio analysis is you trying to what? Measure some of what? Some of the items that we have. You want to develop a ratio on yourself and use it to measure if the company is performing well or not. So the ratio, they can ask you about financial performance. If they ask you about financial performance, you have to know that what will determine financial performance of a company is a statement of profit or loss. So performance will be determined by profitability. So the question asks you to determine the performance of the company, we use profitability ratios, which is the net profit margin, gross profit margin, return on capital employed, which is ROCE. You can also use return on equity, and you can also use the net asset turnover. Okay. The question can ask you to analyze the financial position of the company. They say financial position of the company. Financial position, we are talking about a statement of financial position. And the ratios that we use is the liquidity or the solvency ratio. So you use the liquidity ratios or solvency ratios, which we have the current ratio. The current ratio is just telling you how many times can you use your current asset to pay or to settle your current liabilities now. We also look at what we call the quick ratio. If something should happen right now, how quick will you be to settle your what? Your short-term liability. So those assets that is going to take a longer period or some number of days before it can be converted to cash, we don't include them. Example, inventory. We don't include inventory in the calculation of the quick ratio. We use only the cash, the short-term investments, and the receivables. Those are the items that you can easily convert to what? To cash. Financial position, we still use the gearing ratios. We use the gearing ratios also to know the financial position of the company. The gearing ratios, we are looking at the debt to equity ratio. Debt to equity ratio. We are talking about the capital gearing ratio, which is talking about the capital structure. What portion of the capital structure or what portion of the capital employed for the company is financed by debt? So our current capital structure, what is the debt composition of the current capital structure? If you are having a debt to equity ratio or capital gearing ratio of 75%, it means that the company is owned by outsiders. Outsiders are having more money in the company than the owners. That is not good. We also look at the interest cover. Interest cover. The interest cover.
Sir,
Yes, please.
capital gearing ratio, is it the same as the debt to debt equity?
No, please. Capital gearing is the debt over debt plus equity. That is the capital gearing. The debt to equity is just the debt over equity.
Okay, thank you.
Right. So the capital gearing is we do debt over the debt plus the equity itself. But the debt to equity is just a long-term debt over the equity, over the shareholders' fund. The interest cover, what we are coming to look at is that we are looking at the number of times that we can use our what? Earnings to settle our interest. So if we have a profit of 50,000, profit before tax and profit before interest and tax is 50,000, and your finance cost is 1,000, it means that you can settle you can use your profit 50 times to settle your what? Your interest. This is good. It means that after settling your interest, you still have enough profit to disperse to your shareholders. And that is also telling you that the interest is not going to put pressure on the company, because after we have paid the interest, we are still going to have 49,000 left for us to run the business. So the higher the interest cover, the better it is for the what? The company. Currently, you can use your profit to pay your interest 50 times. It means that you are doing well. And if I should be the one, I can advise the company to go for additional loan because they have enough profit to cover their what? Their interest. But situation where your interest cover is 2 times, it means that you are using half of your what? Your profit to settle your interest. What portion will be left for the shareholders to enjoy as a dividend? And after declaring dividend, what portion are you going to use to what? To run the business again? So if the interest cover is high, that is better. If it is low, that is not good. You can also use the efficiency ratios or the working capital ratios. Working capital ratios to also measure the financial position, which will be the receivables period, the receivable collection period, or the receivables turnover period. It can also be called receivables collection period or receivables turnover period. We can also have what we call the payments, the payables payment period, inventory turnover period, and also the inventory turnover rates. I hope you all know how to calculate these ones. I'm not here to give you formula. I know all of you can calculate the ratios, but your problem is how to write the reports. So I'm here to talk about reports. I'm not here to talk about how to calculate these ratios. All right. It's already 11 and we can't solve a question. So what I will do is that we just go through this question and see what they are saying. Okay. So they are saying that based on the results from this II and this, compare the performance of the two companies. So compare the performance of the two companies. So assuming that let's calculate some of the two ratios. And this one, they're not even asking you to write a report. They're just asking you to compare the performance of the two companies. Straightforward, no reports. But let's assume that we are writing a report and I'll be using assumed figures. Assumed figures to explain how you can write the report or how you can go about the report. Okay, let's look at report writing. So the report writing, you'll be writing a report to a group of people or your CEO or your board of directors. So the first thing is that you indicate who you are writing this thing to. So chief executive officer. Then who is writing a report from who? There may be financial controller. Then what is the date? On what date are you writing a report? You can use the what? The date of the financial statements, or you can use the date that you are writing the exam. So I can assume that it's 1st November 2023. Then the subject. What are you writing a report about? You can say analysis of the financial performance and financial position of this company. Then after that, you come to introduction. This one alone will take like 2 marks. This one alone. The format can take like 2 marks because the report is 20 marks. So you come to the introduction, you introduce your report. So you can start by saying, as discussed earlier, I hereby present to you the report on the analysis of the financial performance of this and this company. This report considers, among many things, the following ratios, or this report was written considering or taking into consideration the following ratios and the financial statement provided. Then you are done. Then you now come to the body of the letter, the body of the report. Okay. Under the body of the report, they are asking you to analyze the financial performance of the company. So the financial performance of the company, this particular analysis can be intra-group comparison or internal comparison, where you are comparing the performance of the same company over years, or you are comparing the performance of the company to an industry average, or you are comparing the performance of the company to a competitor. So you have calculated your ratios already, and you know what measures financial performance. So you have your profitability ratios available. You have your gross profit margin, you have your net profit margin, you have your return on capital employed, you have your return on investment, you have your net asset turnover. So you can look at all these ratios and conclude that, okay, A Limited is doing better than B Limited. That is the general conclusion. A Limited is doing better than B Limited. Why are you saying that A Limited is better than B Limited? A Limited performance in the year 2020 is far better than what? B Limited. This is because the net profit margin of A Limited is this as compared to this. This shows that A is able to control both their fixed costs and their direct cost or variable cost as compared to this. A is able to what? Manage their asset or utilize their asset efficiently as compared to this. So A is doing better than B. What is showing that A is doing better than B? A is doing better than B because the net profit margin of A is higher than B by this amount. This shows that A is able to utilize its asset efficiently. A is able to what? Give discount to its customers that boost their revenue. So you look at some of the items and say what might be causing the increase in the what? In the net profit margin. So First of all, A is doing better than B. What is showing that A is doing better than B? You now bring your figures. You now bring your facts. The performance of A is better than B, as shown by the following ratios. The net profit margin of A has been this and this. The gross profit margin of B has been this and this. The return on capital employed has been this and this. This means that A is able to manage their assets, utilize their assets efficiently as compared to B. This means that A was able to manage their fixed costs and this and this. If this should happen like this, or if the sequence should continue like this, if the sequence should continue in this manner, it means that B is going to be having a problem where A will be doing something. You are done with the financial performance. Calculate the ratios. Say what you have seen. You can also do the analysis by hitting the ratios one by one. That the net profit margin ratio of A is this as compared to B. This shows that this and this might be the cause, this might be the effect. You can hit on the ratios one by one, or you can also put them together and now talk about it in the financial performance, trying to analyze the financial performance of the company. Then you come to the financial position. Financial position means the company is in a better position. The company is having cash. The company is not in the liquidity problem. So use your liquidity ratios. So you can look at your current ratio, your asset test ratio, your gearing ratio, your interest cover ratio, and say that A Limited is having a favorable financial position as compared to B. This is because the current ratio of A is 2:1 as compared to what? B, which is 0.9:1. This means that in times of liquidity, or if the two companies should liquidate now, A will be able to use their current asset 2 times to settle their obligation, whilst B cannot be able to use full of their current asset to settle their current liabilities. You come to their quick ratio. The quick ratio is also this. That is why you are saying that this person is having a higher position or a better position than this person. Then you talk about is why you are saying this. You come to their gearing ratio, the capital structure. One is having a 40%, one is having 20%. The one having a 20% means that there will not be any pressure on their on their cash. Because if the capital structure is 40 against 60, it means that 40% of your capital structure is debt, and you are going to be paying interest. If you are paying interest, it means that every year you'll be paying interest, and there will be a cash, or there will be a problem on your cash. But the one with a lower capital structure will also be suffering, because interest on debt is tax deductible. So if you're not having more debt, it means that you'll not be enjoying tax benefits. The shareholders will be suffering because dividend is not tax deductible. Dividends will not be allowed to be separated from profit before the charge tax on the remaining profits. So you can talk about financial performance. You just go straight forward. The performance of the company in 2021 as compared to 2022 was far better. This is because the net profit margin of the company in 2022 was this as compared to 2021. It means that the company was able to manage costs and this and this and this in this year than this year. Also, the gross profit margin of the company in 2021 has been this as compared to this. It means that the gross profit has increased by this percent. This shows that the company has done this to boost their sales. The company has done this to reduce their variable cost, or the company is now producing at a large scale, which is giving them economies of scale. So you can talk about some of the things. Look at the receivables collection period. If the receivable collection period is now extended, it means that the company is now giving more opportunity to their customers to pay, which is going to encourage them to purchase more, because we are not pursuing them to pay. We are giving it the freedom to pay. So if you have a freedom to pay at your own time or a convenient time, it means that you can decide to buy in excess. You can decide to buy more and sell more. So the report writing is not anything difficult. It's 20 marks. But the only thing is, get your figures correctly, do your introduction, talk. If you are saying this company is doing better than this company, what is showing that this company is doing better than this company? Bring your facts. Quote your facts from the calculation that you have done. talk about some of the causes for that particular improvement or that particular what reduction or decrease in what in performance. All right, I don't have time. If not, I should have solved that question for you. Ladies and gentlemen, my name is, yes, my dad used to call me Linus, but my actual name is Delavania. Yes. So it has been nice having you, and each and every one of you to go through the consolidation is very important. Yes, try to understand it. Try to understand it again. Try to go through it. Try to solve it on your own. The ratio to, you can try to solve that question. If you're having any problem, just WhatsApp me. My number is on the link that you used to join. Just WhatsApp me, and I will guide you. Tomorrow we will not meet, but Friday we will do final accounts with some small standards. You see the theory questions over there, which is the conceptual framework, and those ones you can go through them. You can go through them. So tomorrow we will not meet. Friday we will do some 3 or 2 standards in addition to
final
accounts. Yes. So Friday we will meet, but I'll try to upload the. Yes, the name is God of DB. So if you have any DB in your house, that will be fine. All right.
Do you also have DB in your house?
I wouldn't have been I wouldn't have been looking for DB if I have one in the house. All right. So
You want to marry DB?
I don't want to. I'm not saying that I want to marry. I'm saying that I'm looking.